Alrighty. So welcome to the only covered call course you'll ever need. So what I've done for this video is that I've compiled the very best covered call trainings that I've ever created, and I've structured it and organized it in a very step-by-step fashion so that it gets to cover literally everything you need to know about the covered call in this just one course, right? So this is a pretty big course. It's about 4 hours long, and I'm very confident if you take the time to really go through this training and really learn the concepts and everything that I teach inside this video, then I'm very sure you can master the covered call in the next 4 hours, even if you're a beginner. So if you've ever thought about buying a covered call online course, then guess what? There's no need for you to do that because you get everything for free in this one video, and it's very comprehensive as well. So I would say this is a very complete covered call course where you do not need to watch any other courses on covered call again. So here's what you learn inside this covered call trading course. So chapter 1, first of all, you will learn exactly what is the covered call strategy and how you structure it. Chapter 2, I'll give you a very simple 5-step plan to sell covered calls. Chapter 3, I'll even share with you a few covered call exit strategies. And then chapter 4, you will learn how and when to roll your covered call. So this is a very important topic because many of you would likely want to roll your covered call once they get tested. So in this chapter, this is where I cover everything you need to know about rolling. Now, chapter 5, I'll also give you a very simple system to roll your covered call. Now, chapter 6. So this is where I get into some questions that a number of you most likely have when you start rolling your covered call. For example, should you roll your covered call for a debit? I cover it in this chapter. Now, chapter 7. What do you do if your covered call gets assigned, right? So assignment is something that a lot of people kind of fear when they're trading covered call. So I'll share with you exactly what you need to do. Chapter number 8, I even give you 5 methods to reduce the chances of getting assigned on your covered call. Chapter 9. Should you sell covered calls below your entry price? So for example, the price of the shares that you're holding on to right now might be very much below your entry price. So the question is, should you sell the covered call that is below your entry price? Well, I covered everything in this chapter. Now, chapter 10, should you sell an in-the-money covered call? Right? So this is another strategy which a lot of people have been asking. Now, chapter 11, if the stock is overbought, should you be selling an out-of-the-money or in-the-money covered call? Chapter 12, I'll share with you a variant of the covered call which I call the enhanced covered call. Chapter 13, I even cover the poor man's covered call, which is a very leveraged way to use the covered call strategy. And finally, chapter 14, 3 advanced poor man's covered call tactics to help you increase your profits. So if you're ready, let's dive right into chapter 1. All right, so first of all, what is a covered call? So basically, a covered call is selling a call option against either 100 shares of stock or a long call option. If you were to sell it against a long call option, this would be what you call either a diagonal spread, or some people call it a poor man's covered call. So when you sell a call option against your position, you want to always ensure that you have 100 shares of stock. If you do not have 100 shares of stock or at least a call option, you're going to have a naked call, and this is a very dangerous position to be in, especially if you don't know what you're doing. So always ensure that you have 100 shares of stock first. All right. So with a covered call, basically what you're doing is you're selling the right to buy the underlying stock at the strike price. So as the seller, you have the obligation to sell the underlying stock at the strike price that you've chosen. So here's an example. So let's say you have bought IBM already. You have 100 shares of IBM. The current price is $137.50. Now, you sold a covered call at the strike price of $142 with a DTE of 30, which just means there's 30 days to the expiration of this covered call, and you collected a premium of $2.04. And because there's 100 shares for every option contract, so you're actually collecting $204, right? So it's $2.04 times 100. So at expiration, there's only 2 things that can happen, right? If at expiration, if IBM is above $142, you are obligated to sell your IBM shares at $142. So what if your stock shoots all the way up to $200 or $300? Well, you have to sell it at $142 still. So this is the option contract which you have did with the buyer of your covered call, right? And if IBM is below $142 at expiration, well, you get to keep your shares and you get to keep your premium as well. So it's very simple and it's very straightforward. So why do you want to sell covered calls? So there are basically three reasons that I can think of. So number one is that you get consistent income. So if you can keep selling a covered call every 30 to 40 days to expiration cycle, well, you're going to keep collecting premium over and over again. And this premium can help with your cost basis reduction as well. So that means that the premium which you buy actually offsets the cost price which you bought your stock at. So let's say if you bought your stock at $100, you collected $2 premium for it. Essentially, you have bought the stock for at $98, right? So this is so much better than if you were to just buy long stock and just hold it and just, you don't really get any cost basis reduction on it. And reason number three is you get paid while waiting for your stock to hit your profit target. So if you are doing trading, normally you would place a limit order as your take profit order, as a place where you would, get to close your position and take a profit, right? So instead of placing your limit order to take profit, what you can do is sell covered call at your take profit price. So this way, if the stock does not reach your profit target, you can still collect the premiums over and over again until the stock finally hits your profit target. So this way, not only do you get the capital gain on the stock, plus you also get all the premiums that you have collected while waiting for the stock to finally hit your profit target, right? Alright, so this is the P&L graph for long stock. So I'm using the example of IBM again. So if you were to buy the stock at $137.50, you can see that it's just a very straightforward P&L graph. If the stock goes up $1, you make $1 on every share you have. If it goes down $1, you lose $1 every share you have. Nothing is particularly against you, but there's nothing for you as well. But if you were to sell a covered call, let's say you were to sell a covered call at 142 and you collected a premium of $2.04, so that is $204. You can see the P&L graph right here, right? If the price does not move, you still are in profit. Whereas if you were previously, if the price didn't move, you would not be making any money. But with the covered call, you can see that because you have collected the premium, you will be in profit, even though if the stock doesn't move at expiration, right? And if the stock were to go up all the way to your strike price, the thing is that you will be capping your profit at this price, because then your stocks would be called away. Remember, you have the obligation to sell your stock at this price. That is why you see this flat line here. That means to say that if IBM was to go all the way to 149, your profit would still be maxed out here. That is, of course, if you do not roll your covered call. But that's a topic for another time. But basically, if you were to roll your covered call, you can extend the duration and the time of your profit again, so that your long stock can continue to make more profit as the stock appreciates. The other thing that's good about the covered call is because it reduces your break-even price. Basically, it's the cost basis reduction I talked about. You notice that for long stock, this is where your break-even is. Basically, it's at the place where you bought the stock at. But with a covered call, because you already collected $2.04 for the premium, your effective price of your stock is lower at $135.50 thereabouts, right? That's because you've collected this. So imagine if you were to collect your covered calls over and over again every 30 to 45 days cycle, right? This break-even will get lower and lower and lower. So you have effectively lowered the cost of your stock purchase, which increases the profitability of your stock position, right? So it is always the reason why I tell people that you need to sell covered calls if you have 100 shares of stock. That's the best way for you to hold a stock position. So how do you sell a covered call? So there are 5 steps. So the first step, very important one, is to make sure that you have 100 shares of stock or a long call against it. If you don't have, you have a naked call position, and you better know what you're doing, otherwise you're going to really lose a lot of money. Right, step number 2, you want to look for days to expiration, 30 to 45 days out. That's generally the optimal number of days you want to sell, because you get good premium as well as you have a pretty decent theta decay as well. Now, step number 3, you want to identify where you would like to sell a covered call. Basically, this is the strike price where you want to sell it. Typically, I like to look at the delta, which I will explain more a little bit later when we get onto the platform. But basically, I like to look at a delta of 15 to 25. Some people like to go for a higher delta or a lower delta. This is a really very personal preference, but I think 15 to 25, if it's a good place for you to sell your covered call, if you still plan to hold your stocks for a long time, right? Now, step number 4 is to look at the mark of the mark of the option, and then place limit order around the mark. Then after that, you just adjust, lower the mark until lower the price of your limit order until you get filled. So the very first exit strategy is what I call till expiration do us part. So this is a pun on marriage, where they have the vow where it's till death do us part. So basically you just keep on to your cover call until it expires worthless. So there are two ways to do it, right? So the first way is, if you're willing to get assigned, right, you can just simply wait until the cover call get assigned or expires worthless. So what this does is that it actually gives a chance for your cover call to get out of the money if it's in the money. So for example, if the stock, let's say goes up to this point, you decided to sell a covered call. So if it goes up and then you do not roll it, sometimes there's a chance that it could go up and then go back down, and then it closes out of the money. This way your cover call expires, and then you can go ahead and sell another cover call. So this is the first way. The second way is that you can just keep rolling until your cover call finally expires. So for example, if you, let's say, sell a cover call at this point, so at this point you have a cover call and the stock continues to move up past this point. So at this point, maybe you say that you want to roll up your covered call. So you could roll up to this point, and then if the market goes up again, right, let's say it goes up, right, you can roll it again depending on how far you can get a roll. Maybe this time when you roll, it's still slightly in the money, okay, and then you just wait for it, right? So maybe there's a chance, if you cannot roll for any more credit, you could just wait and see if the market maybe eventually goes down and your cover call expires worthless. All right, so very simple for this. So the next one is to set a fixed percentage to take profit. All right, so this is the most hands-off approach. Very simple. The moment when you sell your cover call, you can immediately place a limit order to place your take profit for it, right? So it can be 50%, 80%, or 90%. These are the most common numbers, right? So if you want to just quickly take profit on it, you can just go for 50%, because a lot of the time, let's say if you sell a 30 days cover call, right, a lot of time if the market moves away from the cover call, let's say the market goes down, you notice that you can easily achieve this 50% in just maybe even the first week after selling this cover call. So you can just close it out automatically, right? Some people like to wait until most of the premium has been taken out, maybe about 80% or 90%. So there's very little management needed, and you can set a take profit order after placing the cover call. All right, so this exit strategy number 2. Now, exit strategy number 3 is to take a loss for capital gains. All right, so basically what it means is to take a loss on your covered call in exchange for potential capital gains on the underlying stock. So I give you an example. Let's say, for example, the stock is here, and then your covered call is already in the money, right? You already got a covered call in the money, and let's say it's at the strike of 100. Now, at this point of time, you want to roll to the next level. Let's say the next available level that you want to roll is 110. But you notice that if you want to roll, it will be for a debit, which means to say that you will have to pay to roll, which is normally not the ideal scenario which we want, because whenever we want to roll our cover calls, we always want to roll for credit. But there'll be times where you notice that you can't exactly roll for a credit unless you really roll all the way very far out in time, maybe to 6 months later. But that's not really ideal for a cover call, right? Ideally for the cover call, we want to have it around the 45 days mark. So let's say at this point of time, the stock is already in the money for your first cover call, and you want to roll to the 110, you notice that maybe you may have to pay a debit. So for example, maybe this time you may have to pay a $5 debit, right? So if you have to pay a $5 debit, what do you gain, right? So there is the gain of $10 in terms of intrinsic value on your underlying stock. So what this means is that you are giving up $5, Right, you're paying out $5, but you can gain $10. That means your net would be a positive $5 if the market actually goes up above this strike price 110 at expiration date. So this way you'll be able to earn the additional $5 on intrinsic value. Right, so I'm going to give you an example on one of the trades which I did. So this was a poor man's cover call which I did on a UNH, United Health Group. So basically on this date, I entered into a poor man's cover call, right? This is on the 1st of October. You can see the date down here, right? So I bought a poor man cover call. I got a pretty good entry, I must say. So this is the leaps. I bought a deep in the money call, and you can see that the break-even price for this is simply you take the strike price, which is 200, plus what I paid for it. The debit is 187. So the break-even price is 387.72. All right, so it's around 388. All right, close to 390. As you can see, this is at this point in time when the market retraced. At the same time, I sold a covered call at the 410 strike price. So this is my a cover call on the lips, so this becomes a poor man cover call. All right, let's see what happened next. So on the 11th of October, as you can see, the market went to my strike price of 410. So at this point of time, I decided to roll it up. But I noticed that when I want to roll it out, I decided to roll 2 weeks out. So when I roll 2 weeks out, the next available strike is 10 points away. Now to roll at 10 points away, I couldn't get a credit, right? If I wanted a credit, I have to roll further out, but I didn't want to roll that far out because at the point in time when I entered into my poor man's cover call, only about 9 days have passed, 10 days have passed. So if I were to roll to a further expiration date, I felt it would be a little bit too far at the point of time. So I didn't want that. So I wanted to roll to the next available expiration date, which is just 2 weeks away. So in this case, the best I could get was a debit for it. So then I have to pay $2.60. So I have to weigh my odds, you know. So I'm going to give up $2.60, right? I'm going to pay out $2.60, but I do have a potential gain of 10 points, right? Because I wrote from 410 to 420. So at this point of time, it comes down to whether I feel that the market still has potential to really go up. So for me, I felt that yes, I think UNH will continue to go up based on what I saw on the technicals. So I decided to do this roll for a debit. Again, I do not recommend it if you do not know whether the underlying will go up, if you're not confident about it. But in this case, I felt pretty confident that it was going to go up. So instead, I decided to just roll for a debit. So this way, I gained a potential $7.40. So I make $7.40 in intrinsic value on the poor man's cover call, on the lips rather, on the long call lips, if the market does go up above this 420 strike price. So I'm giving up $2.60, but I'm going to gain $7.40 in terms of intrinsic value. All right, so what happened next on the November, the 1st of November? True enough, the market went above my cover call at the point of time, which was at 420. So 420 was at this point down here. So you can see that the market really blew past this strike price all the way to around 460. So at this point of time, I decided to make another big roll. So this is a big roll from 420 to 440. So this is a 20 points roll from here to here. And this time again, it's for a debit. So again, I have to ask myself at this point in time, right? Do I feel the market is going to go up? So a lot of times, if you feel it's not going to go up, you don't want to do this roll. But I just felt that it was going to go up, right? I had a look at the chart, and I just had a strong feeling that it was going to go up in the long term. May not be in the intermediate term, but could be in the long term. It could go up. So that is why I wanted to roll this up to give me more room for the leaps to make money. So in this case, what am I giving up? I'm giving up about $15, but I'm going to gain roughly $5, right, in intrinsic value. So is this a worth it trade? This is only a worth it trade if you feel that the market is going to go above your strike price. And in this case, you can see the market has already gone well past the strike price. So anyway, even though if it drops somewhere around here, it's still above this strike price, which means I would have captured this $5 in intrinsic value gain on the leaps. Because if I had just rolled to the same level, 420, I may just get a little bit more credit, but I would miss out on this additional intrinsic value gain. So that's what I decided to do. So I rolled it up to 440. So let's see what happened next. The market in the end did come down. It retraced back down to around 440. So at this point of time, I felt all right, it's a good time for me to roll again, because if you watch my video on the rolling, then you would know that when the market is right at your strike price, you have a covered call, it has the highest extrinsic value. So that's when you have the highest extrinsic value transfer to the following expiration date. So this is where I decided to roll, this time to 450, and you can see this time is for a credit, so it's no longer for a debit. So I did this again. So this time the market blew past again. So this time I decided to roll again. But this time I decided to roll to a much further date, because it became a little bit too deep in the money already at this point. And I didn't want to roll for another debit, because I already rolled for quite a number of debits. So this time I decided to just roll up another 20 points and roll to as far of a date I can to get a credit for this 470 roll. So later on, I started to roll again another 5 points, and then somewhere towards the end down here, this is where I decided to close out this whole position, and then I was able to make a pretty nice gain on this. So if I hadn't rolled up in the first place from this point to this point, I would probably have my covered call stuck somewhere around here if I wanted the same expiration date. But because I rolled twice to take a loss on the covered call, but then overall I still have an intrinsic value gain on the leaps, it kind of worked out, right? It worked out well in the end. So this is one option that you can take if you feel strongly about the underlying stock that is going to go up. So one thing to take note of is, because I have a very long-term call leaps, all right? This call leaps is over a year in expiration date. So I was willing to go for a loss for my covered call, because I know that in the long term, I feel that the UNH will go up. Alright, so that's it for exit strategy number 3. Now the last exit strategy is based on profit per day. So basically the idea is to close your covered call when the profit exceed the daily average profit. Okay, so let me just give you an example. So let's say, for example, you sold a covered call for $3 with a days to expiration of 30. All right, so in 30 days, this covered call will expire. So what is your average profit per day? So you simply just take the profit, or rather the premium, you divide it by the number of days expiration. So you know that $10 is your average profit per day. So on a rough gauge, what I want to see is that I make $10 every day, all right, in terms of profit, all right, on average. So if this profit actually goes past the $10 mark, then I know that I'm actually making more than the average profit that I would make. So in this point of time, if I make more than the average profit, I will decide to close. So for example, this is the cumulative profit. This is the days to expiration on your option. Okay, so for example, on the very first day you initiate it, you see that it's $3. Right, you sold it for $3, and then yes, 30 days to expiration. All right, so this is on the day you sold the covered call. Now 5 days later, right, 5 days later, your cumulative profit should be $50. So let's say, for example, you take a look at your option and you notice your option is worth $2.70. So you sold it for $3, and then you look at the value now, it's only $2.70. So what does it mean? It means that after 5 days, you only made how much? $30 in profit, right? But then based on the average daily profit, you should be making $50. So in a sense, your covered call is falling behind in terms of the profit. So at this point of time, you don't bother to close it, right? You can just hold on to it. So now another 5 days has passed, so total 10 days has passed. So 10 days has passed, your cumulative profit should be $100, right? So it should be by now decayed from $3 to $2, right? But let's say if you take a look at it and it says $2.20, so what does it mean? It means that you only made how much? $80 on your covered call, because you sold it at $3, and if you were to close the position right now, it will be $2.20 only. So your profit is only $80. So you're behind in terms of profit. So I wouldn't close my covered call because of this. Now let's say 15 days have passed since you sold it, so you should be making $150. Now this time, let's say the market really dropped, right? The market sold off, and then you take a look at your covered call now, and you see that your covered call, instead of $3, it's now only worth $1. You sold at $3. Now if you were to close it, you would make if you close it, it will be $1. So what is your profit if you close now? So the profit is $200. So look at this. Right now, if you close it, you will make $200. If you take a look at the daily average profit based on 15 days later, you should be making only about 150. So that means now you have made more than what you should be making on an average daily profit. So this is where you can decide to say, oh, I've already made about $200 out of $300 premium in just half of the time, in just 15 days. What this means is that if I wait another 15 days, right, all the way to DTE 0, if I wait another 15 days, all I can make is only an additional $1, right? So you want to ask yourself, do I want to take the risk, right, when I've already made 2/3 of it in just half the time, and then I have to wait another half the time, another 15 days, just to realize the last 1/3? So this is a question only you can answer, but generally it doesn't make sense, because what if the market rallies back up to your cover call? Then you would have lost this profit, right? So at this point of time, you could say that, all right, I've already made more than the average daily profit. That means I can close it out. So this is basically what it means by closing your cover call based on profit per day. So I'll just give you an example. So just only yesterday, on the 29th of July, Amazon, right, it gapped up based on earnings. Okay, so it gapped up pretty big, as you can see down here, and then I managed to sell a cover call at the 150 strike price for $1 a piece. I sold about 3 cover calls. So today, which is a weekend, on Saturday, when I open up the platform, I noticed that the price of this cover call has already dropped to roughly around 51 cents. So that means I've already made 50 cents, close to 50 cents in just one day. And the expiration date when I sold this cover call is DTE 21. That means there is still 20 days left to expiration. So think about this. I've already made 50% of the covered calls premium in one day. Should I wait another 20 days just to realize the remaining 50 cents, 50%? Should I do that? Now, it doesn't make sense, right? Because I would most likely be risking it, because in case if the market decides to shoot up again in the next 20 days, then I've lost this profit, right? So a better option would be to just close it out when the market opens on Monday. I can close it out, and once I close out, if the market decides to go up again, I can choose to sell another cover call again later on. First thing is, what does rolling a cover call exactly mean? So rolling a cover call simply just means buying back your existing cover call and then selling a new cover call simultaneously, and you do all this in one single order ticket. So for example, let's say you sold a cover call IBM 30 days ago at the strike price of 160 with a premium of $1, and it's now worth 10 cents with 10 days to go to expiration. So DT is days to expiration. Now, you want to sell a new cover call with days to expiration of 45 days and at the same strike of 160, and you can get a premium of $1.60. So to roll, you simply buy back your existing cover call. That means you have to pay 10 cents, a debit of 10 cents, and then you sell the new cover call for $1.60. So this will give you a net credit of $1.50, which is a total of $150, because each option has 100 shares. So if you were to add the last cover call that you sold, which was at $1, plus the additional credit of this new cover call that you have rolled into for $1.50, you have a total of $2.50, which is netting you $250. So essentially, rolling a cover call just means the process of buying back your cover call and selling a new one in one order ticket. So the next thing you must understand is that there are different types of rolls, right? And this is the terminology that we use in options, right? So the first type of roll is rolling out, and rolling out simply just means to roll to a further expiration cycle. So for example, let's say you already have a cover call that you sold in October, right? Rolling out means you buy back the October cover call, and then you sell the following month's cover call in November. So you can see in this example here, you buy back your existing cover call 15 October, at 150 strike, and then you sell it at the next expiration month, which is in November, at the same strike, and then you receive a credit for it. So that's simply it. That's what rolling out means. The next is rolling down. So rolling down means simply to just roll to a lower strike price in the same expiration cycle. So if you had sold the 15 October cover call, basically rolling down just means to roll down your strike from 150 to something lower. So in this case, I use 145, and in this case you will again always be receiving a credit, because most of the time when you're rolling down, it just means that the underlying stock is going down as well. So rolling down can give you more credit to cushion the downfall of your underlying stock, the equity which you have bought. Next is rolling out and down. So it's a combination of both of them. So it just means to roll to a further expiration cycle and then to a lower strike price. So in this case, you originally had the cover call on 15 October at a strike of 150. So you buy this back and then you sell the next month's expiration cycle at a lower strike price at 145, and this will net you the most credit, because not only are you getting credit by rolling down, you also get more extrinsic value because you're getting more time in your cover call, and that will give you much more credit. Okay, the next would be roll out and up, and that means to roll to a further expiration cycle and to a higher strike price, and that means basically to buy back your current cover call and then to sell the next month's cover call at a higher strike price. Now this is normally a defensive move, and it's actually a good thing because your stock, your underlying equity, would have gone up to your current strike price, your current call, your cover call strike price, and that's where you're going to move it up. So you're actually doing very well overall, because the main driver of your profits come from your long stock, and your cover call is just a means to reduce the cost of your stock, but the main profit driver is still your stock. So you actually do want the stock to go up to your cover call, because it then means you are profitable on your overall position. Alright, so when exactly do you roll? So there are three scenarios that basically that's when you want to roll. So the first scenario is when your cover call is almost worthless. So you can see in this example here, you sold a cover call at 165. You can see that the stock has gone up and then it has come down, and around this time, you know, you're running out, your cover call is almost near the expiration date. So at this point of time, chances are that your cover call is almost worthless. So this is the time where you do want to roll, because if you have already, let's say you have sold the cover call for $1 and there was 45 days to expiration when you sold it, and 15 days into the cover call, the value of your premium is now worth 20 cents. And that means you have already made 80% of your cover call premium. So there's no point for you to hold another 30 days just to realize 20 cents, right? When you've already made 80% of it, you already made 80 cents in just 15 days. So the better move would be to just close out this cover call and then sell a new one. So this is where you might want to either sell by roll out to the next month at the same strike price, get some more extrinsic value waiting for a rebound, or if you're a little bit more aggressive, you could roll down or roll out and roll down. So at this point of time, this is the pretty much the only discretion that you're going to have, and it all comes down to your view on the underlying stock. If you feel it's going to go down some more, you have a very bearish outlook, then you might possibly just want to roll down. Or if you feel that it's really going to go down some more, you can just, you know, roll out and roll down. So there's no right or wrong, no one way to do this. It just comes down to your own outlook of the underlying stock. Now, scenario 2 is when your cover call is at the money. So the stock has gone up to your cover call strike, and in this case, it's actually a good scenario because your underlying stock, your equity, is actually making a lot of money at this point. Most likely that you probably have bought it somewhere here, your cover call is here, so this is where your profits are for your equity. So at this point of time, you want to ask yourself, do you want to get out of the stock? If you do want to get out of the stock, then it's fine to just leave it there, all right, and then wait till expiration to see if your covered call is in the money. If it's in the money, your stock is going to get called away. But if you are holding this for the long term and you do not want to be assigned, this is where you want to start to roll. All right, so you want to roll once the equity, the stock, has gone to the strike of your cover call. So at this point, you can choose to either roll out to the later further expiration date, or you could roll out and up and give more room for your stock to continue going up. All right. Now the third scenario is when your cover call is in the money. So for some reason, let's say maybe you want the stock to be called away, right? So you let the stock go in the money for your cover call, and then once it's in the money, you decide that, hey, you want to try and get a little bit more profits off your equity. So this is where you can choose to roll out and up for break even, or maybe even a little credit. Maybe you can roll up to 2,400, extend the time, and if by expiration it's still in the money, then what you have done then is you have gotten an additional profit from 2,300 to 2,400. Now if you were to just leave the covered call at this point, it's perfectly fine as well. It's just that you'll be getting out of your position at 2,300, right? So it really comes down to, again, your outlook. If you feel that the stock is going to continue to go up, you could just keep rolling this bit by bit, let it get in the money, and then you can choose to leave it to expiration if that's the price at the point in time that you want the stock to be called away. But if for some reason that you left the cover call, that means you were too busy to manage your positions, and suddenly you see that it's in the money and you want to salvage the position, well, the only thing you want to do, and by the way, when I say salvage position, means you do not want your stock to be called away and you want to hold the stock for the long run. The best you could do is just roll out and up to the furthest expiration, or to one of the expirations much further than where you are right now, to see whether you can get at the money or out the money. If you are already at a very far away expiration cycle, let's say for example there's about 180 days left to go and you're already in the money, there's very little room left for you to manage this. So chances are that you could roll out and up probably to 2,400 or maybe slightly higher, but then that would probably be the max that you could roll out to, and pretty much your stock would get called away once it reached expiration if the price stays above your strike price. But that would be a long time away. Normally it's closer to your expiration, or when the extrinsic value of your cover call is almost zero. That's when you would likely get assigned before the expiration date, right? Okay, so how do you put all this together and have a very systematic approach to rolling your cover call? So I love to think about it in a very systematic way, because I have many positions at one time, over 20 positions at one time, having covered calls. So I want to have a very systematic way to manage them rather than be very discretionary and be confused. So there are three systematic methods that you can use to roll your cover calls, and the first one is the most simplest and the most passive, and it's the best if you don't have a lot of time to manage your position, and that is to roll based on days to expiration. So a good DTE to look out for would be around 21 days, because chances are that you wouldn't get assigned even though you're in the money, because there's still pretty much a lot of extrinsic value left. So basically what you do is you just put on the cover call maybe at 30 to 45 days out, and once it reaches the DTE of 21 days left, that's when you look at your position and you choose to roll. Right? If it's out of the money at that point of time, all you have to do is you can choose to roll out to the next month at the same strike price, or if the stock have significantly dropped, you can choose to be slightly more aggressive, roll down, or you can roll out and down. And if it's already in the money and you do not want your stock to be called away, you do not want to be assigned, then what you do is you just roll out to the next to the next calendar month, or you can just roll out and up. So this is the simplest and most passive way, and if you don't have a lot of time, this will be the most suited for you. The next will be roll based on the percentage of the premium. So let's say the cover call that you sold off is $1. So the time where you would want to roll this is at a percentage of how much premium is left. So if you set a premium, let's say for example you decide 50%. Once you've already collected 50% of the $1, which means that the cover call has dropped to 50 cents, that's when you decide to roll. All right, it's very straightforward as well. This has a little bit more management compared to DTE, all right, because you have to pretty much log into your platform to see whether you are in profit or not. Right, so you can set it at 50% or 80%, and that's when you can choose to roll. If it's close to the expiration date, all right, for example DTE 20, and you still haven't reached the 50%, chances are that the stock has gone to your strike price or it has gone in the money, then that's where you want to do the same as this. You want to roll out or roll out and up. Now the final method is to roll based on delta, and this is my preferred approach because again I mentioned that I have many positions, and the best way and the easiest way for me to see if I have to do anything is by arranging all my cover calls based on the delta. So most of the time I'll be starting off the cover calls position at around 25 to 30 deltas. So if the delta was to drop to 10, then I'd already know that the premium has dropped by quite a bit, and chances are I would have already reached a 70% profit off the cover call, which also means that the underlying stock has probably dropped or has gone sideways, right? So when it reaches delta 10 or below, that's when I'll decide to roll. So chances are I'll either roll down, roll out, or out and down, again depending on my outlook of the stock at the point in time when I decide to roll. Now the other time where I will start to roll is when I do not want to be assigned. So that's when I'll take a look at the cover calls that have crossed the 50 delta mark. So delta 50 just means it's at the money. That's exactly when your strike price is at where the current market price is. So at this point of time, for the long-term holdings where I do not want to get assigned and I'm just holding it for the long term, this is where I'll start to roll. And most of the time, I'll only do rolling out and up. And what that means is basically I'll try to get more room on the upside for my equity, for my long stock. So hopefully I could get a few strikes out. Let's say if I've already sold a cover call at 100 strike, I might try to get 105 or even 110 if it's possible. And the most I'd be willing to do it for is at break-even price or a small debit, but I'll not go more than that. So if I can get a break-even, that would be the furthest strike price that I would roll it to. So again, if I roll it at if I have a strike price of a cover call at 100, I want to see if I roll it to the next month, how far up can I get the next cover call at? Is it at 105? I can do it at break even, or can I even do it at 110? If I can do it at 110 for break even, I'd rather roll to 110 at break even than to roll to 105 and get a small credit, because at the end of the day, to me, the stock is where I make most of my profits. So this is I'm placing more emphasis on the profits of the stocks rather than trying to reduce the cost basis of the premium that I'm trying to get through the cover calls. Now on the stocks that I do not mind getting assigned, that's when I'll let it really run in money and only reach probably delta 80, where most of the extrinsic value has pretty much dried out, is pretty much gone, and that's when I'll consider rolling. If I do not want to get out of the stock just yet, then I might roll out and up to the next strike at break even or even a small little credit. But if at this point of time, delta 80, I see that I cannot roll to the next strike, then I might just roll out, keep the same strike, get a little bit of extrinsic value then, and hold out for probably another 30 days or so and get that extra premium. So this is what I see in my platform Thinkorswim. So basically you can see this is all the positions that I have for cover calls. So the column which I focus on each and every single day is this column, the delta. I totally ignore this P&L open because it's at this point it's insignificant. Everything is being managed by my delta. I can have a good picture of what my cover call is doing, where the stock is, just by looking at the delta. Right, so you can see that I've let this stock ITA pass 50 deltas, and for this I actually do not mind getting it assigned. I actually do want it called away because I do not plan to hold this for the long term. So at this point of time, I'm not planning to roll this at all. I'll let it go to probably around delta 80, and if it's really deep in the money, then what I can do is probably roll out one more time, because I know for certain the next month, 30 days later or 45 days later, if it's really very deep in the money, chances are that at expiration date it will still be in the money, and I could at least get a little bit more extrinsic value, a little bit more premium to offset the cost of the stock, which contributes to my bottom line, to my profits. For next is, some of them you see it's past 50, but you have to take notice, because for BABA I have actually two cover calls here. So I have two cover calls here, which means that this is the overall delta, and you have to divide it by the number of positions you have. So divided by 2 for this will be around 26 delta, so this is pretty fine. So at this point of time, if you were to look at all the deltas, you would just see that anything above 50, I will look at it. If it's below 50, in between 10 and 50, there's absolutely nothing to do. Absolutely nothing to do. I just sit on my hands and look for other trades. I do not have to bother about my cover calls. But when I see a cover call, you can see EM drops below 10. That is when I'll start to look for rolling opportunities. So once I see it's 10, chances are the stock has either gone sideways or gone down, and that's when I'll start to roll it. So in this case, I'll most likely roll out and down, or just roll down depending on how much premium I get. So this is a very systematic and very orderly fashion for you to look at your cover calls and decide when exactly you have to roll your cover call. So if you've been wondering when you should roll your cover calls, or if you should even be rolling your cover calls in the first place, then one good way you can use to determine that is by using one of the option Greeks, which is delta. So what is delta? Delta basically just measures the rate of change in an option's theoretical value per $1 change in the underlying security. And bullish option strategies have positive deltas. So let's say you decided to buy a call option on Nike with a delta of 0.8 for $13. Now this is a deep in the money call option. So let's say if Nike was to go up $1, that means that your call option would gain 80 cents and it would become $13.80. And all else being equal, that's because there are other factors that actually affect the pricing of the options, like for example volatility. So if all else being equal, then your option will gain by the delta that your option has. And if Nike was to go down $1, then your call option would lose 80 cents, and that would become $12.20. Now bearish option strategies on the other hand have negative deltas. So for example, you bought a put option on Nike with a delta of negative 0.5 for $4. So that means you want the market to actually drop, because if you're long a put option, if the market drops, you make money. If the market goes up, you lose money. So if Nike was to go down $1, then your options would theoretically lose 50 cents, becoming $3.50. And if Nike was to go down $1, then your options would gain 50 cents, becoming $4.50. Now, cover call options, this strategy in general is a positive, it is a bullish strategy. But when you log into your brokerage software, you would see that it has a negative delta. And the reason is because this is in essence just a short call. Cover call strategy consists of the long stock portion and the short call. So the long stock portion is where you get 100 deltas, and you were to square off with the short call. Let's say the short call here is negative 21. So you have roughly a positive 80 delta. So in general, cover call strategy is a bullish strategy, but on your platform, you will see your call as a negative delta because it is a short call. And in general, if you do not want your stock to be called away, you do not want the stock to climb up past your cover call strike. So why do you want to use delta to roll cover calls? Well, first of all, it's a very simple metric to manage multiple covered call positions, because delta will let you know if you should roll your covered calls or not. And because of that, there's no need to look at charts. So for example, if you were to see your covered call positions and you see that it has lesser than 50 deltas, then you know that the cover call is out of the money. at this point of time, there's pretty much nothing to do. You can just let it expire out of money, see until the expiration date. If it's still under 50 deltas, that means you collect the full credit as it expires worthless. Now, if you see that your covered call has a delta of 0.5, that means the stock has climbed all the way to your strike price. And if you see a delta of more than 0.8, that means you see a negative 0.8, negative 0.9, then your strike price has been breached. The stock has gone above your strike. And if you do not roll, you will get exercised. That means your stock will get called away at your strike price at expiration. So we will be using this as a way to determine whether you should be rolling and when you should be rolling your covered calls. So when do you roll? And this comes down to the objective that you have. In general, there are two objectives. The first objective is that you want to hold on to the stock. You like the stock so much and you want to hold this as a long-term investment. So if this is the case and you see that your covered call has a delta of less than 0.5, well, at this point, there are three things you can do, right? The first option is that you can just let it expire worthless, right? You can just leave it as it get closer to the expiration date. If it's still out of the money, you can collect the full credit if it expires out of the money. That's the first option. Now, the second option is that you can consider taking profit. Right? Some people like to take profit at 50%. Some people like to take profit at 90%. So this is a personal preference. And the reason some people like to take profit is because, number one, they could be worried that the stock will suddenly rally and they do not want their stock to be called away, so they take profit. Or number two, it could be that you're making more in terms of dollar per day if you were to take profit at that point in time. So let's say you sold the covered call for $1 and it is a 30 days to expiration option, and within the first, say, 7 days, you already realized 50% of the profit. So it makes more sense at that point of time to just close the option and take 50% of the profit in 7 days than to wait another 23 days to get the other 50%. So again, this is personal preference and it comes down to how you like to manage it. Now, the third option is that if your stock has been dropping, especially in a bear market or when the market has crashed, then you might want to consider rolling down to try and get more credit and cushion the capital loss that you have on your stock. All right, not really a capital loss, but more of a drawdown. So you're just using the credit that you get from your covered call to reduce the cost basis of your stock. Now, what if the delta reaches 0.5? What this means is that the stock has climbed all the way to your strike price. And if you do not want to have a chance that your stock is to be called away, then this is where you want to consider rolling. So how you would do the roll would be to roll up and out for either a credit or break even. So to roll up and out is pretty simple. What it just means is that you're basically going to roll to a higher strike price and then to a further expiration date. So if you want to know about the different types of rolling terminology, there's a video that I've already created. You can click somewhere on this video, and in that video it will share with you all the different types of rolling. Now, this is what you want to do if you want to hold on to the stock. Now, what if you do not mind having your stock called away, right? You have probably made quite a bit on the stock already. The stock has already gone up quite a bit and you want to just sell off this stock so that you can move on to the next position. Well, in this case, if you see that your covered call has a delta of less than 0.5 and it's out of the money, you do the same as the previous objective, that you do not want your stock to be called away. Right? It's exactly the same options. The only difference is that this time we can let the covered call actually get in the money to about 0.8 deltas. And the reason we allow it to go all the way to 0.8 deltas is, before we decide to actually do something about it, is because at around 0.8 deltas, that is where most of the extrinsic value has gone, right? And what we're trying to do with covered calls is basically just try to get all the credit we can get all the extrinsic value that we can get, right? So if the covered call has become a 0.8, it's already pretty deep in the money. At that point of time, there's not much extrinsic value left. So there are two options that you can do. Number one, you can roll up and out for credit or for break even. But if you can't, then you have no choice but to leave it and have your stock called away. So this is the only difference, because some people might want to use 0.8 because there is a chance that the stock could drop back down. Let's say, for example, the stock has climbed up way past your strike price to roughly 0.7, 0.75, and then the stock starts to make a U-turn back down. So it could go back down and become out of the money again, and you didn't have to roll, and somehow it could actually expire out of the money. And if it expired out of the money, you could collect the full credit. But had you rolled when it became 0.5, then what you have done is that you have extended the time just to collect that same credit or slightly more credit than that, right? So you would be getting less dollar per day if you were to do that. And what if the stock just keeps rallying? At the point in time, you could be just rolling up and out all the way until your days to expiration on the option could be 100 days or 200, even 200 days away, right? So there is a give and take. So it comes down to your personal preference. But in general, if you don't mind having your stock called away, then it is okay for you to let the covered call reach to a 0.8 delta. Now, so this is how I would manage on my platforms. As you can see, I have quite a number of positions, and these are all the covered call positions I have. So what I do each day is I will just log into the platform and I'll just take a look at the delta. I will arrange it in a descending order, so I will know which options, which covered call I have to take notice first and possibly do some actions on it. So the first thing I'll do is I'll take a look at all the deltas that is above 50 and above. So at this point of time, I'll ask myself, hey, is this a stock that I want to keep, or is this a stock that I don't mind having it called away? So if this is a stock that I don't mind having it called away, then I do nothing. I just let it wait. It could probably just expire out of the money at expiration date. The stock could come back down, or it can continue to go up, and then when it reaches delta 80, then I will roll. But if at this point I would say that, oh, maybe Baba, I want to keep this stock. I don't want it to be called away. So at this point of time, this is where I will look to start to roll out and roll up. So once I've done these three stocks down here, I will move on to the other covered calls that is out of the money, right, below 50 deltas. Then I will take a look at them, and generally I do not do anything that is near the 50, even all the way to the 20. If I see a covered call that has a delta of let's say 10 and below, then I would just open up the covered call position, take a look at the extrinsic value and see, is there any extrinsic value left? If there's not much extrinsic value left and there's still quite a number of days left to expiration, then it doesn't make sense for me to just leave it there. I would rather just close it and then open up a new covered call on other positions, or wait for the stock to go up again before sell another covered call. So as you can see, this is a very simple way for you to manage your covered calls. And just at a glance, if you are busy, you are outside at work, and you have no time to look at the charts, you can just pull up your brokerage software, take a look at the delta, and then decide, okay, this is what I need to do, this is where I need to roll, or there's nothing for me to do. So a very simple method, very systematic as well, for you to roll your covered calls. So whenever we're rolling a covered call, the general rule of thumb is to always roll your covered call for a credit. That's because when you roll for credit, right, you can reduce your cost basis over time, and it also helps cushion the losses if the stock drops. So having a covered call, in this sense, when you're rolling for a credit, it really helps you get more profits over time. But there are times when you actually can't roll out and up for credit, right? So when we are rolling our covered call, most of the time we want to be rolling out and up, because this way we can get some credit extrinsic value. At the same time, we make room for the underlying stock to go up, right, in to gain some intrinsic value, because ultimately the driver of a covered call profit is from the gains of the underlying stock or from your long call if you are doing a poor man's covered call. So there are times when you can't actually roll out and up for a credit, is when your cover call is deep in the money and when you don't want to roll too far out in time, right? Ideally, we want days to expiration 45 for optimal theta decay. So for example, let's say that we have sold a cover call somewhere around here, right? So at this point of time, the market has gone really high, really went above our cover call, and it's pretty much deep in the money. So ideally, what we want to do normally is to roll up and up in time, right? So we roll to a further expiration date. At the same time, we want to roll to a higher strike price, so we gain more on this difference down here in the underlying stock, right? The intrinsic value gain down here. But the problem is that sometimes when it's too deep in the money, you can't actually roll for a credit. So if you want to roll for credit, you may have to roll to a much further expiration date, right? What happens, if you sold a 45 days cover call down here, and within just the next 5 days, your cover call got breached. So in this case, you may need to roll to a much further expiration date, maybe to the 60 days or 90 days, or may have to go even further to 120 days or more, right? So when it becomes too far out, right, we don't really have this optimal theta decay, because the speed of the theta, where the extrinsic value really starts to decay from 45 days down to 0. But if you were to have a option that has about 90 to 120 days or more, it's going to have much lesser theta decay. So this is where we really need to balance, the strike price at the same time as the days to expiration left on the covered call. So this is one of those times where you may have to roll for a loss, right? So you may have to roll for a loss, and it means that you are very bullish on the underlying stock, right? If you're very bullish on the underlying stock, then it does make sense to roll for a loss, and you are also prioritizing intrinsic value gain on the stock or the call option. And also at the same time, you do not want your covered call to be too far out in time, right? So I'm going to go over to the TD Ameritrade platform to show you exactly what I mean. Okay, so we are in my Think or Swim platform here by TD Ameritrade. So I want to give you an example, right? So let's say, for example, on this chart down here, let's say for UNH, let's say you sold a cover call at around the $500 mark, and the market right now has gone all the way to 537. So around this point of time, you might say you want to roll. So if you want to roll, the thing is that, right, you may have maybe you still have 37 days left to expiration on this cover call, right? You may have sold it around 45 days, then just within 7 days, the market has gone way above your cover call, right? So at this point of time, you want to roll it. So here's the dilemma that you may face. So for example, if you want to roll your cover call, most of the time we want to roll to the next expiration date, right? It could be for the 44 days. So this is normally the optimal time frame which we want to roll a covered call to, because this is where we have optimal theta decay. But there are times when you do this, you realize that you are not able to roll for a credit, right? So for example, if I want to roll out and up, you see if I roll to 510, it'll be for a debit. So if it's for a debit, you'll be actually giving up $7.68 just to get maybe about $2.32. So we may want to adjust this, right? So let's say if we were to go to a further outdate, can we get a credit? So this is the kind of a decision-making process you have to make when you roll. So at this point of time, you see you can roll to the 21st October, but it becomes 72 days to expiration. So it's quite far out in time, but you still get a debit, but at least the debit is not so bad. So you'll be giving up $1 to get $9, roughly $9 in intrinsic value gain. So that means you'll be rolling to 510. That means if the market is to stay above 510 at the expiration date, it means that you actually gain an additional $8 something, right? Almost $9 in intrinsic value gain. If you had just wanted to roll for a credit, right, you may have to roll all the way, or maybe you may just want to stay to 500, right? If you roll this, you will only be getting $6 in terms of extrinsic value, right? So if you roll for a debit for a loss, and the market stays above 510, you'll be getting about $8.85. But if you were to roll just to the same strike price, you get $6, but you lose out on the $2 in intrinsic value gain. So this is kind of a dilemma that you have to make, right? A decision that you have to make. Now, what if you rolled it to even further out to try and get a credit? So let's say I roll to the 510 and I'm going to roll to 16 December. Now, if you roll to 16 December, it's definitely going to give you a credit. In fact, you're going to get $680 for the roll, right? So $6.80, you can roll to 510. But the problem is that now you have rolled too far out in time, right? It's 128 days. So if you're going to roll for 128 days, what happens if UNH continues to rally from here and it goes all the way to 600? And if, let's say, imagine if it goes to 600 in, let's say, 30 days. If it goes there in 30 days, now your option would have roughly 100 days. And where are you going to roll it to? You're going to roll it even further out in time, and it reaches a point where it's going to be few hundred days out just for a covered call, which it doesn't really make too much sense then, because your money will be tied up in this position and you're not going to gain any additional money as well. So this is where the balance you have to make. So maybe this is where you might want to consider rolling for a loss. So this is where maybe you might consider going to 21st October and then roll to 510. So this way, at least it's not too far out in time. As you can see, the difference between 21st October and 16th December is about 50 days out, right? 50 something days. So that's pretty far out in time. So if you were to roll to the 21st October, it's at least not too bad, right? It's about 72 days, and then you still can get a $9 in intrinsic value gain, about $9. So you'll be rolling this to 510, and then you still have 72 days left, right? 72 days left, and hopefully the market, do not rally too far up, and it could maybe hit the resistance points before coming down. And that's when the days to expiration left will start to get slightly lesser. And as you get slightly lesser, that's when your theta decay can start to pick up and starts to erode the value, right? Capture most of the profit on your covered call. So this is one of the kind of the dilemma, the predicament you have to face. So I'm going to give you an example of actually what I did on this stock, on UNH, where not too long ago I actually did roll for a loss. Okay, so this is a trade on the UNH, United Health, where I had to roll for a loss a few times. And I'm going to share with you the decision-making process I had on why I decided to roll my covered call for a loss rather for a credit. So on this date, I actually did open a position for the poor man's covered call, where I long a call somewhere around this price down here. Which is quite a pretty good price, and then I sold a cover call at the 410 strike price. Now, just a few days later only, as you can see, just a number of days later, it breached, or rather it touched my cover call at 410. So at this point of time, I wanted to roll because it seems very strong to me. And if you watch my video on the rolling the cover call, you'll know that if you do not want your stock to be called away, the best time for you to roll your cover call is when the market actually reaches your cover call strike price. And since it was pretty early on in time when I first sold my cover call, right, roughly about 5 to 6 days since I sold the cover call, I wanted to quickly roll this to a further out in time, as well as roll to a higher strike price before it gets too deep in the money, because I'm still pretty bullish on the stock, right? So on this date, I decided to roll it out and up in time. But the problem is that when I roll it out and up in time, right, I had to roll for a debit, as you can see down here. And the reason is because I only rolled it out about 2 weeks later. I didn't want the expiration date of the cover call to be too far out, because at this point in time, my cover call when I first sold it is around 45 days, right? So 5 days has passed, it's still around 40 days. So if I were to roll it out again for a credit, it may extend to maybe 70 days or 80 days, and I didn't want to hang on to a cover call that is too far out. So at this point of time, the decision which I made, or rather the thought process which I had, was that I was hoping that the market would go up and then kind of come back down within this time frame. So this way my cover call would expire out of money, and they would just leave me the long leap, right? So this is because I kind of have a very bullish outlook after this move up down here, especially after it had a very good earnings report. So that's my decision down here. So when I rolled this up, right, one thing to notice is that this is a 10 points move up, right? So I moved up from 410 to 420. So what is it that I gave up? So I gave up any positive extrinsic value to gain some intrinsic value on my underlying long call position, right? So when I do this, what I'm essentially doing is I'm giving up $2.60 to gain $10. If I give up $2.60 to gain $10, well, my net profit would be $7.40 if the market really does go up above 420. So at this point of time, this is pretty much kind of a little bit of a balance, also a little bit of a risk, because if the market actually doesn't go up above 420, all right, and then it just goes immediately from this point in time, it goes down, then I would have actually lost $2.60 just for rolling this for a loss. So what happened next, as you can see, the price really did gap up, and from there it just continued going up. So this was a very strong momentum up. So on one end, I was right on the direction that it went above 420. So in this case, I actually gained the 714 intrinsic value, right, because I wrote it up there, but it went way too high above my strike price. So at this point in time, I had to make a decision to make another roll, because I could get exercised if, right, the market continues to go up in time and never comes back down. At the same time, I didn't want to just lock my profit to just this small little portion down here, right? The profit is being locked because of my cover call, and my entry price is somewhere around here. So the next thing I need to do is to decide on the roll. At this point in time, I decided to do a roll from 420 to 440. So you can see that is a 20 points roll, but then I took a loss of roughly $15 in debit, right? So why did I do this? So the reason I did this is because I couldn't find any other strikes, or rather I couldn't get a strike that I wanted, right? I wanted to go from 420 to 440 for a credit, right? Because it has already gone too deep in the money. And while I could go even further, right, you notice that I actually wrote from November to December, which is about another 1 month out. The thing is that I didn't want to go to January or February or even to March, right? I didn't want it to go too far out in time. So this is where I thought that, you know, if I were to roll to the 440 points, and if the market was to continue going up, right, again, I'm still very bullish, because again, after this positive earnings, right, I felt that if the market was to continue to go up, I would be able to gain the $5 in intrinsic value, and I give up $14 right down here. So I give up $14 to get $20. I will get an additional $5. So at the end, you can see that UNH really did continue to go up all the way, right? It ended up even higher later on. But after this time, I managed to roll a few times after the market came down. I rolled it up a few more times. I think eventually I rolled it to about 470, right? And the remaining rolls, I did it for credit, because I already did too many debit rolls, which I didn't want to erode anymore into my profit. So I decided to do a credit roll later on. As you can see, if I do the credit roll, I only could limit myself to 470. If I had done a debit roll, right, I could have probably gotten even further, maybe to 490. But then again, the market has already gone pretty high up at this point. So around 470, I kind of felt that maybe the market may be a little bit overbought, right, over exhausted to the top. It may start to make its move down. So I decided to get out of the whole position as a whole, right? In the end, it did go up. So well, at the end, I still did get out for a pretty decent profit, so I'm fine with that. But here's the thing to take note, right? If I hadn't rolled for a debit at this point in time, right, or if I had rolled out for a cover call very far out in time for a credit, the problem is that it will be very hard for me to roll this cover call later on, because if I'm too far out in time, it'll be harder for me to want to roll from a 180 days position to a 240 days position, if you understand what I mean, right? So I wanted to kind of balance the number of days to expiration left, as well as the strike price which I want to roll to. So in hindsight, this was actually, I thought it was actually a pretty decent roll, because although I gave up, you know, any credit for rolling on the cover call, I managed to gain the intrinsic value difference, right, by rolling to the strike price which I wanted, right? So I rolled for 20 points, I gave up $15, I gained a net $5 at the end of the day, right? Because the market still continue to go above my strike price. All right, guys. So whether should you roll a cover call for a loss, ultimately this is a decision that you have to make. But if you feel you're very bullish on the underlying stock, then it doesn't really hurt to roll for a loss if your view is right. And if you can roll for a small debit, that will be good as well. But at the end of the day, you really have to manage, right? You have to balance the strike price as well as the days to expiration left on your covered call. What happens during a cover call assignment? So most of the time, right, when your cover call is in the money at expiration or near expiration, when there's very little extrinsic value left, there's always a chance for you to get an early assignment. So that's where your cover call will get assigned, and then your shares will get called away. So it's 100 shares per cover call. So at this point of time, actually it is a good situation, because chances are that you may have bought here and the market went up, and then you are actually in a profit. But you might want to continue to hold on to your shares because you think that the market is going to continue to go up, right? So what do you do then? So there are a few things that you can do. So right now, let's say for example, your cover call is in the money and it's yet to be assigned, right? I've spoken to some people. Some people say that they want to actually close out the cover call for a loss so that they can still hold on to the stock. Now, I don't really suggest this unless you are really bullish on the stock, right? You think that the point in time where you closed out the cover call, the market will still continue to go up. Then if you feel that's the way, then yes, you can close out for a loss on your cover call. But you have to understand one thing, is that the stock doesn't actually go up in one straight line, right? It doesn't do that. Stock will always move in wave patterns. So it will come down, consolidate a little bit, go back up again. So the point, let's say for example, if you bought at this point and then maybe you sold a covered call at this point, right? So at this point of time, if you saw a cover call, the market goes all the way up here, then you decided to cut loss on your cover call, chances are this may not be the best move, because the stock can always come back down, right? So for example, in this case, if the stock comes back down to this point, if you had held your cover call, what you could have done is just roll out and up, right? Add more time to it and then see if you can roll up to a higher strike price. So in this case, you can always keep the cover call and you just keep rolling up. Just keep rolling as much as you can, rather than to take the loss on the cover call. Because if you were to take the loss on the cover call and then the market kind of retraces back again, then you kind of regret taking a loss on the cover call, which defeats the whole purpose of selling the cover call in the first place, right? So if you are in this situation right now, then maybe it's better for you to just wait for a retracement and then to roll your cover call up and out, right? If you cannot roll up, you can just continue rolling out and then see if the market comes back down again. So your two methods for this: you can roll your cover call out and up, and then to roll out. Right, so what if you're already assigned, right? So the first question you want to ask yourself is, are you still bullish on the stock? If you're not sure, right, if you don't think it's going to go up, then there's no point to re-enter into the stock again. You can just go and find another stock which you think there's a chance for it to go up. There's many things you can do with your funds to find another trade setup. There's no need to go onto the same stock. But if you are still bullish and you think that the stock is still going to go up, then you want to re-enter into the stock. There are a few different methods that you can do. So I'm going to share with you 4 methods. The first method is to just simply buy back your stock. So for example, right, if the current price right now is down here, and then your cover call, you got assigned down here, your shares got called away here. If you think that the stock is still going to go all the way up, then you can just simply just buy the stock outright, right? If you think it's going to go up, there's no harm buying back right now. And then although you're losing this much in terms of the gain of your stock, because your shares have been called away here and then you're buying here, right? It's not that much of a big difference if the market is still going to go up. So especially if you're buying this for long-term holding, you're going to hold on to your stock for the next 5-10 years, then there's really nothing wrong for you to just go outright and buy the stock. Now, if you don't feel comfortable buying at the current price, you think it's a little bit too high, you can see the stochastics here is overbought, you can just place your buy limit order simply at a place where you had your cover call assigned. So this way, if the market comes back down, you will be filled on this, and it's as though the cover call didn't happen, right? You still managed to get your premium on the cover call and you resume back this position. Now, of course, this is the best scenario. Next thing you can do, instead of buying at the current price or just placing a buy limit at where the cover call is, you can actually just wait for a pullback, right, to see the stochastics, to see whether it's oversold. So at the moment right now, you can see it's overbought, right? If the market goes to the point where it's oversold, right, there's a good chance for it to be a turning point. So if the market comes, let's say, below where your cover call got assigned, you could actually buy it at a better price than where your shares got caught away. But if the price, let's say, comes down to here and you see that the stochastics is oversold, then you could, make a case to just buy your stock down here as well. Right? There's nothing wrong with just buying the stock if the market is going to shoot back up later on. Now the next thing you can do is to split the order into several buy levels. So if you don't feel comfortable, just buying the full lot size which you have, the full 100 shares, or how many shares which you have at the current market price, then you can actually split them into different levels. So this way you actually still have some skin in the game in case the market shoots up, right? It's because you at least still have 25% of the shares which you got caught away. If it goes up, you still make a little bit, but in this case, if let's say it goes down, right, you do not get all your shares at the current stock price. At least you wait for it to go down, you buy a little bit as it drops, buy a little bit more as it drops. So if it goes down to level 3 and then it goes back up, at least you have a pretty decent average price at somewhere around buy level 2, right? If it goes all the way down, even better still, right? So in this case, right, you're kind of like managing the balance between the different ways of entering the stock, right? If you buy at the current stock price and then the market doesn't goes up, it goes all the way down, you kind of feel a little regret of buying too early. But then if you buy at the limit order, you place a limit order at the cover call strike price and it never gets there, comes down and goes all the way up, you kind of regret again because you have no skin in the game. So the best thing, if you're feeling that way, is to just simply buy into, split into different buy levels. Now method number 2 would be to re-establish your cover call. You can just simply re-establish the position which you previously had by just buying the stock outright at the current price and then selling the cover call at where your cover call got assigned. So in this case, you're actually resuming the position. So what you want to do here is to sell a cover call that is a further dated one. So maybe, for example, the cover call that got assigned, maybe it had 20 days to expiration. So instead of selling the 20 DTE which got assigned in the first place, you don't want to do that. Because if you were to just sell the cover call with 20 DTEs left, it could just get you assigned again. So what you want to do is sell a further DTE instead. So you want to go for maybe somewhere around 45 DTE. So this way you pick up some extrinsic value as well. And you also gain back all the intrinsic value which you have lost between this point to this point, right? So some of you might be worried, you're saying that if I buy at the current stock price and your shares got caught away at this strike price down here, would it mean that you would have lost this amount? Now, you wouldn't be losing this amount if you sold the cover call at this strike price, because you're actually regaining back the intrinsic value which you lost by selling this cover call, right? So by selling the cover call at the same strike price, you recover the stock's intrinsic value that you lost. So here's what I mean. So for example, this is the stock price right now. You can see the last price is 254.51, right? The bid is 254.53, 254. Now if you take a look at the intrinsic value down here, it's trying to say that the price of the stock right now is around 254.53. So let's use this price as where you will be buying the current stock price right now. So if you were to buy the current stock price right now, it's 254.53, and let's say your cover call, let's say you got caught away at 240, right? 240. So we'll be looking at this column, this row down here. So if you take a look at this row, if you were to sell this price, what you notice that is you will be selling at $18.35. So if you think about it, the stock price, the current stock price and the cover call strike price, the amount which you actually lost, the difference, is 254.53 minus 240, which means it's $14.53. You lost $14.53 on where your shares got caught away and where you're buying the stock price. But if you take a look at the price which you're actually selling this cover call, you're actually selling at $18.35. So you're actually getting more than what you lost. Because when you sell the covered call, you will see that it actually has an intrinsic value of 14.53. That means when you sell this covered call, you're actually regaining back all the intrinsic value that you have lost from this point to this point, and on top of that, you still have an extrinsic value of $3.82. So in this case, you are fully resuming back the position which you did, and you're adding on some extrinsic value as well. So at this point of time, the only messy thing, or the thing that you might find it awkward or hard to really comprehend, is the stock price. Because when you take a look at the stock price compared to before, you may have had the stock price somewhere down here, but if you buy the stock price at the current price, your broker will be showing your price as this current strike price, which is 254.53. So if the market was to go down somewhere down here, you might see a loss on your broker, but you're actually overall in a profit because your original price is here, which you had already taken off the profit from this point, right, to down here. So this is one thing you want to take note of. But overall, this whole position is exactly the same as you would have if your cover call previously did not get assigned. The only difference is that you had already rolled out with extra extrinsic value of $3.82. So this is how you can re-establish your cover call. Method number 3 would be to sell a cash secured put, right? So you can just simply sell at the same strike price where you sold your cover call previously. So this way, if the price doesn't reach past your cash secured put and the price continues to go up, at least you still are able to get some premium from your cash secured put. Now, if the cash secured put, which you want to sell at where the strike price for the cover call is yielding too little premium, doesn't give enough premium for you to collect, then you can just choose to sell a 30 delta cash secured put, right? So maybe a 30 delta might be here, or maybe it might be here, right? Wherever it is, you can just sell a 30 delta cash secured put so that you can get some premium. So in this case, if the market goes down, right, it's easier for you to get assigned on this cash secured put, which is what you want, because you want to resume this position. Right, so you can just sell a 30 delta cash secured put if the strike price which you want to sell the cash secured put at doesn't give you the kind of premium which you want to receive. Now, instead of selling the cover call straight away, you can of course just wait for the stock to pull back. Right, you can see that the stochastics is overbought, so there is also a chance that the market can come back down. So if it does come back down, you can just wait until it gets close enough, then you can sell the cash secured put at where your previous cover call was. So this way, right, if the market goes down, you will be able to get back at the same price at which your previous shares got called away at. Finally, you can do it the same as how we did in the buying the stocks outright. You can just split it into several cash secured put, right? So let's say, for example, you had 300 shares called away. If you had 300 shares called away, you do not have to sell all 3 cash secured put at one level. You can split them into different levels. So it's the same psychology as splitting into different tranches. You can sell one cash secured put at 50 delta at the current stock price. So this way, if the market does shoot up, you don't get assigned. At least you still get a pretty decent premium. Or if the market goes down, right, you don't have to put all your eggs in one basket, in a sense, where you don't have to sell all 3 cash secured put at the current stock price. You can wait for it to drop and then sell another cash secured put as it goes down, and then sell another cash secured put again. So again, you're splitting up into different buying tranches. Now, the last method would be to sell a put ratio spread. Now, previously I've already created a video on a put ratio spread. You can go ahead and watch that video. I put a link at the top right hand of the corner. But basically, you can sell a put ratio spread, which is a good way to buy into stocks, right? So a put ratio spread basically is to buy 1 put option and to sell 2 further out of the money put options. So the way you want to see this is having an embedded bear put spread. So a bear put spread is where you buy 1 put option and then you sell a further out of the money put option, and then you sell 1 additional cash secured put. So basically, it is 1 bear put spread plus a cash secured put. Now, the put ratio spread is very flexible, very versatile. You can split them into many ways. So instead of doing this, maybe you might want to put your buy put down here plus 1, and then maybe you want to put your 2 put options down here as well, sell the 2 put options. So it's up to you to adjust the strikes however you want. So it's very flexible in this way. So ideally, what we want is to try and get our cash secured put portion of the put ratio spread to be in line with the cover call strike price, because this way you'll be able to get back your shares at the same price at which it got called away before. But there are times, you can't really arrange it so that your cash put is here, especially if your stock price is too far away. So in this case, you might want to split up the short put option. So here's what I mean. You can sell your cash secured put at the same strike price at where your cover call was. So let's say, for example, you receive maybe $2 in credit for this. So if you receive $2 in credit in this, you want to try and find, the strikes where you are buying the bear put spread. So you want to have your long put at the money. So this way, any movement down, right from the current strike price, you'll be able to make some money on your bear put spread, rather than if you were to put your bear put spread starting from this point all the way to this point. So the market has to drop lower in order for you to profit on your bear put spread. But if I were to put my bear put spread at the money, this way, if the market just drops a little bit and it expires here, let's say at expiration it expires here, it doesn't get to my cash secured put, in this case at least I will still be able to make the money right from here all the way to here. So the whole idea down here is you want to adjust your bear put spread to see how far of a strike, how far you can get in terms of the width of this bear put spread with this premium. So sometimes you may adjust back and forth. Now ideally, of course, you want this -1 put down here to coincide together with this cash secured put. So this way you have the biggest profit from here to here. But many times if your strike price of the cover call, right, of the cash secured put where you want to be aligned with the cover call is too far away from the current stock price, chances are you're not going to get quite enough premium for you to make such a wide bear put spread. So that is why you want to try and measure or try and adjust it to see how far of a width that you can get. So generally what I like to do is I will find the strike that's at the money for the put that I'm going to buy, and then find the furthest put I can get for roughly the same debit as the credit which I received. So roughly I'm looking for a debit of around $2 as well. So this way net they will cancel out each other. So the whole put ratio spread you can put on for $0 or for a slight credit. Alright, so that is for method 4. Okay, so let's get into some takeaways. So if you sell cover calls long enough, there will be times where you can't avoid an assignment, right? If your shares are caught away, it's not the end of the world, because you got to understand that the stocks don't go up in a straight line. You can always get it back after the stock get assigned, right? Your stock gets called away. Because in the long term, if you're bullish, as long as it goes up from where you re-entered, you will still make money. So there are 4 methods. There are 4 methods to re-enter into the stock. So the first thing is you can buy back the stock directly, right? So this is the easiest and the simplest way to ensure that you actually get back into the stock in case the market goes up. Now, method number 2 is to simply just re-establish the cover call. That means you just buy the stock at the current price and then you sell a further dated cover call at the same strike price. So this way you're resuming the position, and then you still add on some extrinsic value as well, so it wouldn't be called away so soon. So at the point of time, you can always just keep rolling once the extrinsic value gets lesser, or when there's lesser time left in the cover call. Now, method number 3 is to sell a cash secured put. Many ways to sell the cash secured put. You can go back to see that section on it again. And the final method is to sell a put ratio spread. So this way, if you get assigned, you get paid on the way down, and then you still get back your original stock position as well. First method is to choose strikes with low deltas. Now, if you don't already know, delta is the measuring of the rate of change in an option's theoretical value per dollar change in the underlying security. So this is the definition. But for the purpose of a cover call, we're not going to look at it because it's not that important. Instead, what we want to know is that delta is also used as a gauge of the percentage chance that the option will be in the money at expiration. So I want you to take a look at the option chain here. So on the left hand side, you can see these are all the call options. So this is the column that is showing the probability of the strike, all right, the option being in the money at expiration. And on the right hand side, this is the delta. So you can see that it is actually very similar. So this has a delta of 66. So it roughly have a 62% chance that this strike, 132, would be in the money at the expiration date of 5th August 22. So down here is 50 deltas, so that roughly should have 50% chance. So as you can see, it's very close, and all the way down to 3 deltas. So 3 deltas roughly have 2%. Now if you were to pull this up in your brokerage software, you could just bring up the probability of in the money. All right, but if your brokerage software does not have this, a quick way would be just to look at delta, because it's very, very similar. So you can see that on the right hand side, this is the stock of IBM. Right now the stock price is around $137.62. So if you want to select a stock price that have a roughly 10% chance of being in the money, right, that means you're looking for the delta of 10, which is roughly around here. So the closest that we have here is 8 deltas. So 8 deltas, that is a strike of 155. So that would be selling a covered call at 155 strike. Now if you're thinking of getting more premium, then you would want to be selling the higher deltas. So deltas, let's say 30 deltas. So 30 deltas, you notice that the premium is roughly in between $2.25 to $2.59, so it's roughly about $2.40. So you get about $240 for selling the 144 strike. But the problem with that is that it is pretty near where the current price is. So that means there is a much higher chance of you getting assigned. And I'm sure this is one of the problems that many of you guys are facing when you're selling a covered call. You're not sure, should you be selling a nearer strike but getting more premium, or should you be selling a further away strike so that you get a lesser chance of getting assigned? But the premium is quite minuscule. Like for example, if you were to sell the 155 strikes, you only get about $42. Yeah, that's not a lot compared to getting $240 with the 144 strike. So there's a trade-off here, and if you want to ensure that your strikes, that your covered call do not get assigned, then what you want to do is select the covered call strikes that have a low delta. And by low delta, generally it's 10 to 15 delta. So basically it has 10 to 15% probability of in the money. So if your priority is to not get assigned, but at the same time you want to still get some money at the side while holding on to the stock for the long term, then 10 to 15 deltas is a really good place for you to sell covered call strike. Now of course, if you are a little bit more aggressive, you feel that the stock for some reason is not going to go past that strike price of say 25 deltas or 30 deltas, you can go for it. But most of the time, right, or rather 25 to 30% of the time, it will go in the money, and that means there's a chance of you being assigned. So if we want to go for the deltas that have a very low chance, or rather the strikes that have a very low chance of getting assigned in the money at expiration, then we want to go for these two strikes, which is the $150 strike and the $155 strike. So it's up here. So as you can see, it's much further away than the 30 delta strike, which is 144. So ideally what we want to do is choose the strike that is as far as we can get but still give us some premium, and preferably we want it to be above some sort of resistance. So as you can see, around 145 the price has bounced off, touched it once, come back down, touched it, and then come back down. So 145 is roughly a resistance, and that is the second method to choosing covered call strikes that don't get assigned, and that is to choose strikes that's above resistance. So resistance is basically where price have trouble going up. So if we take a look at this chart of the QQQs, can you identify where are the places that have a possible resistance? So if you have identified somewhere around here, which is above the 400, you're right. As you can see, price have tried to break above this price many times, but each time it goes up, it comes back down, goes up, comes back down, goes up, comes back down. So we know this is a pretty strong resistance point. So if price was to get up somewhere to around 380, and then you have a chance to sell the cover call, you want to sell one that is above this resistance, so that there is a good chance that the price will not go past this price, this level at expiration. Okay, the next level is at around 370. As you can see, price bounced off here, come back down, go back up to the price level again, hit resistance, come back down. And another place down here, another resistance, go up to this price, cannot break above, consolidates, come back down, go back up, come back down. So the price is slowly, gradually making its way back up again. So let's say, for example, you do have a position in QQQs, then a good place for you to sell the cover call strike would be above this level. Especially, you can see that this is a moving average. So another form of resistance is a dynamic resistance. So dynamic resistance comes in the form of moving averages. So moving averages can serve as a resistance a lot of the time. As you can see down here, the price also came up here close to the moving average, and then it comes back down. So you can use this as a way for you to determine where you can sell your covered call a strike. So if you can sell one that is above the resistance, then it gives you a much better chance that your strike, your covered call, is not going to get assigned. Now you might be asking, what if, you know, the resistance is still quite far away, and if I were to sell a strike, let's say at $320, I won't be getting any premium? Well, if that's the case, then you don't want to sell a cover call right now. You just want to wait until the price goes back up slightly higher, maybe around 300, 305. Then you can consider selling a cover call above this resistance. So again here, can you find out where the resistance is? All right, so it's pretty obvious. There are two resistance levels here, right? One is $177.50. Another one is down here. So as you can see, price is approaching resistance, and the price has moved up pretty continuously without having any sort of a big retracement back down. So there is a good chance that if price were to hit this level, it could come back down afterwards. So if you are long this stock, which is Pepsi, you could sell a cover call above 172.5 or above 177.5. All right, so the third method would be to only sell the cover call when the stock is overbought. And when I mean overbought, basically it means looking at the indicator. So in this case, I have the stochastic oscillator. It tracks whether the market is overbought or oversold by these two lines. There are other indicators as well, such as the RSI. So it comes down to your own personal preference. For me, I like to use the slow stochastics in this case. And as you can see, a lot of times when the market is overbought, it tends to reverse back down. Now, of course, it doesn't work all the time, but at least it's much better than if you were to say sell a cover call when the market is oversold. Because when the market is oversold, there is a good chance that there will be a bounce back up, right? And if you're selling a cover call, you do not want to sell your cover call when the market is oversold. So having this as an indicator of when you should be selling your cover call does actually help. So if you were to take a look at this chart, there are a number of times that when the market is overbought, it comes back down. So you can see on the left hand side, if it's overbought, when it's overbought, the market comes back down. Another time the market goes up, shows an overbought signal, and it retraces back down again. And then another time when it's overbought, comes back down. So as you can see, there are a number of instances where there is where the market is overbought, and in this case, you can see that every time the market is overbought, it comes back down. So it does help that when the market is overbought, you can sell a cover call strike, and then it immediately comes back down for you to take profit on the cover call, right? So if let's say you sold a cover call for $1 at a expiration date of 30 days away, right? And if the market was to drop immediately, like right now, in this instance down here, and your cover call is showing a profit of 50%, that means the $1 becomes 50 cents, and it's just only like a week in, you can actually choose to close your cover call because you've already made 50% of the profit in 7 days. So it doesn't really make sense for you to hold another 23 days just to realize the other 50%. This way you are risking your chance, you're risking your cover call getting in the money or getting exercise if somehow there is going to be a rally. So if you see that there is a 50% profit somewhere before the 50% of the expiration date is left. So if 30 days expiration date, less than 15 days, you get 50% profit, then it's perfectly fine to take profit on it. So it is a very good way for you to identify when to sell the covered call. Now, the fourth method is to avoid earnings when you want to sell covered calls. And the reason is that earnings can really make the price move. There's going to be huge movements if the announcement, the earnings come out is not as expected, and that can cause the price to gap up or gap down. So while earnings can actually give you a juicier premium because of the increased volatility, there's going to be a huge movement. Now, if it's a gap down, of course, it'll be good for your covered call, but not so good for your underlying stock. But if there's a gap up, then there's a good chance, or maybe a strong high probability that your covered call will be in the money. And if you don't want that to happen, then you do not want to sell any covered calls going into earnings. And by that, I mean to avoid selling any covered call that expires after the earnings is announced. So for example, if they're going to announce the earnings on the, let's say, the 30th of June, you do not want to buy a covered call, you do not want to sell a covered call past that date. Rather, you want a covered call that expires before the earnings, so you do not trade this, you do not get the covered call into earnings. So if you take a look at this stock, IBM, you can see that whenever there's earnings, there's quite a big price movement. In this case, there's a big candle going up, and for this, you can see there's a gap up. So if you want to avoid all this, especially if you do not want to have your stock called away, then it's much better for you to just avoid selling your covered calls when the stock that you're in is about to announce earnings. So again, another stock, this is CRM. As you can see during the earnings announcement, there is a huge gap up as well. So here's a better way to do it. Rather than enter a covered call before the earnings, what you could do is actually sell the covered calls after the earnings is announced if there is a gap up. Because a lot of the times when there is a gap up, a lot of people will want to take profit at that point in time, right? So that is why you can see there is a sell down. There's a saying that, you know, the stock wants to close the gap. All right, it doesn't happen all the time, but a lot of times it does. So in this case, you can see there's a gap here, and subsequently after the earnings announcement, the price goes up, and then after that it comes back down to fill up the gap before going back up again. So if the earnings announcement is a good surprise for some reason and the stock starts to rally, what you could do is at this point you could actually sell a covered call somewhere up here, say at 200, 205, 210, depending how much premium you can get. And also, of course, if there is a resistance above this, is a good place for you to sell your covered call as well. So the key thing here is to avoid going into earnings, avoid selling a covered call into earnings. Now the fifth method is more of a protection, because you could sell, you know, the covered calls based on the four methods which I just shared with you earlier, but for some reason there's a very strong move in the stock and it does reach your strike price. So at this point of time, to avoid the chance of it actually being a sign, you want to roll the covered call when the delta is 50, and that means the stock reaches your strike price. So the moment the stock goes up to your strike price, you start to roll. Right, and the roll you want to do is out and up, and that means to roll to a further expiration date and to roll it to a higher strike price. So you can see this example. Let's say that you have a covered call initially at the 150 strike price. So what happens is that IBM probably went all the way up, touches 150. At this point of time, you want to roll. That means you buy back the 150 and then you sell the following month or any other expiration date that is later than 15 October, and you want to sell the highest strike price as well. In this case, you can see it's 155. This way you have a lesser chance of it being in the money at expiration date. So I want to give you a visual illustration of what you actually should be doing if you do not want to have your covered call be in the money. So what you're going to do basically is you're going to keep perpetually rolling your cover calls whenever the price has reached your strike price. So if you can see here, the stock is, imagine the stock is at this price, so you will be selling your cover call above here, and then if the stock goes up to your cover call, what you do is you roll it up, and then you wait for the stock to move again, and if it goes back up again to your strike price, you're going to roll it up again, and if it goes up again to your cover call, you're going to roll it again. So you will be rolling this over and over again, and this is the best way that you can avoid having an in the money cover call, having it assigned an expiration if you already have a cover call. All right, so you might be wondering, how far can you roll out? Well, the thing is that you can keep rolling out all the way until the furthest expiration date, until it becomes a leap, right? So you could be starting off with a 30-day cover call, but if the price just keeps on rallying and it's a very strong move upwards, then you're going to keep rolling it from 30 days to 60 days to 90 days, 180 days. You could even be rolling to 300 over days until a year plus. So that is the downside, right? At least you do not get assigned. You will have less chance of getting assigned. And because when the stock, or rather when the cover call has an expiration date of 300 plus, or when it's ridiculous amount, right, maybe a year or more, chances are you won't get exercised, because nobody want to exercise it until it's close to the expiration date. So you keep doing this until either A, you can't roll out anymore, and that is the maximum date of expiration that your brokerage has provided for you. That's the furthest that you can roll to. Or once it's all the way in the money already at that point and you cannot roll for more credit, then you have no choice then for it to be assigned. Otherwise, this is your best chance, or the best way that you do not get your cover call strike assigned. And if you want, and anyway, because you are already holding the stock, you want the stock to hold for long term, so it shouldn't bother you that much that your cover call is also that long, right? Because you want to hold the stock for a long time and you do not want to have your stock called away. Alright, so let's put it all together. So for the lowest chance of having your cover call assigned, here's how you should select your strike. First, you want to select the strike with low deltas, which is 10 to 15 deltas. Ideally, you want all this together. Alright, so with low deltas, and then it is also above a resistance area, and the indicator which you're using, a stochastic or RSI, is saying that the stock is overbought and the stock is not having any earnings announcement, right? If you have all this four, then you should go ahead and sell the cover call, because there is a very good chance that the cover call will expire worthless, right? And finally, you want to roll when the price reaches to your strike of 50 delta. So the key here is to be very selective with your cover call strikes. If you want to sell a cover call, be very selective. That means you won't be selling all the time. You won't be thinking of, I want a fixed number, $1,000 or $2,000 every month by selling cover call. You need to throw that out of the window and not have that mindset, because if you do not want your cover calls to be assigned, then you cannot just force a cover call each time. You only can sell a cover call if the market moves in a way where you get these four criteria, right? So the upside of this is that you get to keep your stock. Although you do not get to sell as many cover calls as there is, you at least get to keep the stock, which is what you wanted in the first place. So normally when we sell a cover call, what we want to do is, ideally we want to sell it above our entry price, right? Because we never know what the stock can do, right? For example, if the stock is going to suddenly just shoot up way above our cover calls, and then we are not able to roll out and up in time, right? We're not going to get any extrinsic value from rolling out and up, then in this case our shares will be called away at expiration, right? Or even early before expiration if there's not much extrinsic value left in the covered call. So in this case, at the very least, we would still get profits, right? We will get the intrinsic value profits, the capital gains from our long 100 shares where we bought at this price and we get called away at this price. So this is our profit, including the premium which we sell from the covered call. So this is how we generally want to sell our covered calls. Now, but what if the stock is now way below our entry price, right? And then can we still sell the covered call below entry price to reduce our cost basis? So you may have bought 100 shares maybe somewhere up here, and now the stock has gone all the way down here. All right, so at this point of time, can you still sell your covered call? And if you were to take a look at the option chain, you may find that the only covered call strike price which can give you a decent amount of premium could be somewhere here. And as you can see, this is way below where you first bought your 100 shares, right? So the biggest risk of selling covered calls below your entry price is locking in your losses, right? So locking in your losses basically just means that the point in time where your shares get called away, if your covered call gets exercised, is way below your entry price. So previously we saw that the capital gains is from where you first bought it to where you sell it, right? Where you got called away. In this case, as you can see, where you bought it and where your shares will be called away if your covered call is exercised is different, right? So this is a loss because you will be buying it at a higher price and you are getting your shares called away at a lower price. So this is the biggest risk of selling your covered call below your entry price. So in this case, if you're willing to accept the risk of locking in your losses and you still want to sell the covered calls to reduce your cost basis, then you want to be very selective with when and where to sell your covered call. So what I'm trying to say is that I do think that you actually can still sell your covered calls even though, right, the strike price might be below your 100 shares, but you need to keep in mind or bear in mind that there is a chance that if the stock was to suddenly rally all the way up and may even rally to the point where you first bought the shares, right, you may be locking in a loss. So this is where you need to be very picky with where you sell your covered calls, right? Now, for myself personally, I generally do not want to sell any covered calls that's below the entry price because you never know what's going to happen with an individual stock, right? There could be sudden news that would just make the stock, just gap up all the way above the cover call, and then it makes it very difficult to roll, right? I understand that, some people have the strategy that, if the stock, let's say it goes all the way up to your cover call, you might want to just keep rolling up and up. And yes, there's definitely a strategy to do that, right? You can continue to keep rolling until it eventually reaches the price where you bought it at, or you might even roll it above the 100 shares, which is definitely possible. But the only risk with this is that if the stock really rallies very quickly past your cover call, then it could be difficult to roll up and out each time. So if you want to reduce cost basis while still selling, cover calls below your entry price, then I would suggest to be really selective. And it's definitely very possible if you are good with timing the markets. All right, so I'm going to give you a few suggestions if that is what you want to do. So when we come to selling our covered calls below our 100 shares, we want to try as much as possible to reduce the risk. So every time when I look into a position, look into any strategy, I'm always trying to think of, what are ways to reduce the risk? How can we ensure that we have the lowest chance of the worst outcome as much as possible? Now, of course, if you were to just hold this 100 shares and you do not have the covered calls and the market, right, was to just keep going down, then of course you would be better off just selling this covered call. But then again, this all comes down to the stock selection when you first got into this position, right? So if you got into a stock where it never goes up in the long term, no matter how many covered calls you sell, it's still not going to help you mitigate the amount of loss you're going to get from where you first bought it to where, the market crashes all the way to. So when you want to look into any of these positions, you don't want to look as covered call to salvage your positions, but rather it's meant to have a supplementary income on top of holding your long 100 shares, which is meant to be the main driver of your profits. So ultimately, good stock selection is still important, right? All right, so to reduce the risk of locking in a loss, there are a few ways to do it. And this is what I would suggest. So number one, we want to wait until the stock is overbought. That means to look at certain indicators like RSI or stochastics. For me, I personally use the stochastics. So basically, the stochastics have two lines, right? So this is overbought and below is oversold. So what we're looking at is for the stochastics to go above this overbought. Now, of course, again, as I always stress in many of my other videos, overbought can always be more overbought. As you can see, this oversold can still continue to be oversold as the market crash. But what we understand from this indicator, that it at least indicates that there is a higher probability that the market will be going down when it's overbought than it going up, right? So if you had a choice to either place your cover call when the market is oversold or overbought, which would you choose? Right, so the smarter decision would definitely be choosing it when it's overbought, because there is a higher chance of it going down, which is what you want, because ultimately you're selling this cover call not to get your shares called away, but to reduce the cost basis. So imagine if the market right now is telling you that it's oversold down here, and then you start to sell a cover call, right? Let's say at this point of time, all right, let me just remove all these drawings so we can see. So let's say at this point of time, right, the market looks like it's going down, and you want to try and reduce the loss on this, right? Momentarily loss as the market goes down. So maybe you try to sell a cover call down here, right? So maybe at this point in time, you might sell a cover call that seems pretty decent. There's quite a distance away from where the current market price is down here, and then you still get quite a decent amount of premium. But as you can see in the next few days, right, this is a few bars later, maybe just a few weeks later, you can see that the price suddenly just shot up above here. Now at this point of time, you can see this price move is pretty quick, pretty fast. So it may be difficult for you to keep rolling up and out. So if the market still continues to shoot up, then what you have done is that you have essentially just locked in your losses from this point all the way to where you sold your cover call down here. So that is why I would prefer to sell my cover call when the stock is overbought. So again, I will wait until the stochastics indicates that it is overbought. Then I will start looking to choose my cover call strike price. So next, what we want to do is we want to sell a low delta cover call strike. So generally, we want to sell something that is less than 15 deltas, because remember, deltas also is a quick indication, or rather a quick estimate of what is the percentage that this strike price will be in the money at expiration. So 0.15 just indicates that there's roughly a 15% chance that the cover call strike price would be in the money at expiration, right? So there's only a 15% chance that it will go above here, or rather it will close above here at expiration, right? During the whole course of this time, right, it might go up, go down, and then go back up again. All right, so it's important to understand that when we choose a 15 deltas, it just means that there is a 15% chance that the market will actually close above our cover call strike price at expiration, which is good for us, right? We do not want a too high of a delta, although you get more premium on the delta. But if you were to sell a 30 delta, maybe it would be somewhere much closer to the market, somewhere around this point, right? So as you can see, it's much easier to go up. Now, the loss which you're going to lose, right, in terms of the difference between this value, the two strike price, and the premium, right, this will always be greater than the premium which you receive. So for example here, this might be 5 points, right, 5-point difference, but then the cover call premium, you might probably only receive $2 or maybe up to $3, right? So that is why I would rather sell a further away cover call, receive less premium. So in this case, I will have a lesser chance of the stock price, right, the stock going above here. And maybe if it does touch here, there might be not much extrinsic value left that I could just roll out and up. So basically, when I sell a low delta cover call strike price, it will really reduce the chance of the market actually just going up above here and avoiding this locking of the losses, which is as much as possible we want to avoid. So the next thing we want to do is to sell our cover call above a resistance level or a previous high as much as possible. So market always move in waves, as you know. So the wave right? Whenever there is a resistance, there's always a chance that the market could turn down. So previous highs are basically places where the market, right, as you can see, has shown that there is some sort of selling pressure. You can see the market came down here, went up here, and then it went back down here again. So this can serve as a previous high. So what you want to do is you want to sell a cover call strike price that is above here, because there could be a chance that the market goes up here and then it meets with resistance and then it goes back down again, right? And also we can also take a look at the dynamic resistance levels. That means it doesn't just have to be previous, support resistance levels or previous high. It could be moving averages as well, right? So as you can see, this moving average could serve as a dynamic resistance. That means as the market go up here, it can from here find some sort of a selling pressure, some sort of resistance, and then it comes back down again. So a few of these criteria, these three criteria, will help you really reduce the chance of the market really going past this cover call strike price, right? So the last one is to avoid selling cover calls into earnings, because as we already know, earnings is very volatile, right? It can go either way. It doesn't matter, what the earnings results is. What comes down is the interpretation of what the market views it to be, right? It could be good news, could be good earnings, but then the market might just sell it off, right? Or it might be bad news and the market all of a sudden just, buy it up and there's a big gap up or gap down. So that is why you want to avoid selling cover call into earnings. Now, I know some people could be tempted to sell cover calls into earnings because that's when the premium are the most juicy, right? Maybe during normal times, you could sell this cover call for, let's say, $1, but when it's close to earnings, right, maybe this $1 might be beefed up to $2 or maybe even $3, right? So you might be, very tempted to sell a much juicier, a more premium cover call strike. But the thing is that it also factored in the volatility. That means there is a chance as well that the market could just gap up, right? So if you have seen some of the earnings from, let's say, Facebook, right, Meta, even Amazon, Adobe, you can see there's a lot of a gap when the earnings come out, right? So if you want to avoid the chances that there could be a huge gap up, right, it may even gap up above your cover call strike price, and at this point it becomes quite difficult for you to roll out and up, because your cover call is going to get a little bit too expensive. If you want to roll out and up, you may even have to roll to such a very far dated expiration time, right? So maybe if you sold this, let's say you want to do the weeklies, right? Maybe you sold a 14 days DTE, right, cover call, and then on the earnings day itself, the next day it just gapped up somewhere down here, right? So if it gapped up way above your cover call strike price somewhere around here, if you want to roll out and up right now, you will notice that you may have to roll all the way to 90 days or maybe even 180 days, and this 180 days may not even be above where you first bought your 100 shares. So you may be stuck with a cover call strike price. Maybe the most you could roll up to would be maybe this price, right? If you roll it to this price, you may have to hold it for maybe 180 days. So this is one of the traps that you have when selling a cover call that is below your entry price, right? If you hold it on to this strike price for 180 days, you cannot let go of it, and the worst thing is the market continues to rally. And if that happens, you're just much better off if you had just not sold the cover call in the first place, right? But of course, we want to reduce our cost basis. We want to sell the cover call. So the best way is to use these 4 criteria which I've set out to reduces the chances that your cover call strike price will end up in the money at expiration. So what do you do if your cover call is breached? So let's say if you have already, followed these 4 criteria which I've set out down here, and then the stock price goes all the way up to your cover call, right? So what do you want to do? So there are 2 methods that you can do. So I've actually created a video on rolling cover calls already. If you haven't watched that, please go ahead and watch that as well. I'll put the link at the top right hand corner of this video. But basically, if the price reaches your cover call strike price, if you want to be really defensive, then this is where you want to roll, because as much as possible, you do not want to let the cover call get in the money, right? You do not want it to expire in the money at expiration. So once it touches your cover call strike price, this is where you want to roll out and up, right? So whenever the strike price, or rather the stock reaches your cover call strike price, there is always a chance, or rather an opportunity, that you can roll out and up, because it hasn't actually gone inside your covered call yet. So at this point of time, at the money covered call strike prices have the most extrinsic value. So you have the most extrinsic value transfer to the following months, right? So you can always roll out and up, and you can keep doing this to keep rolling, and hopefully it can roll to the point where you are at least at the point where you first bought your 100 shares, if not even higher than that, right? So this way you can at least lock in a profit. So this is what you want to do if the stock price touches your covered call. Now the downside of this is that, as I mentioned earlier, is that you could roll all the way to a much further dated expiration date. So maybe you start off with 14 days, right? Let's say you start on 14 days, then maybe let's say 5 days later it touches your strike price. It touches your strike price. Now you want to roll out and up. So if you roll out and up and you notice that the furthest you can go to, or rather the nearest that you could go to, where you can get a decent, a distance away, the next strike price, wait, maybe 60 days to expiration. Then maybe another 10 days later, it touches the strike price again. Then you got to roll it up. Maybe this time you have to go up to maybe 85 days. And then maybe if the market rallies again, you have to roll it up all the way to, I don't know, maybe like 180 days. So at this point of time, you'll be stuck with a covered call that has 180 days to go. So what this does is that it actually limits your profits, because you have to hold on to this covered call for 180 days. Now from here, it is possible that the stock can just rally above this point. Now at this point, if you rally up again, you want to roll, it's going to get a little bit too far out. Then you'll be holding on to this covered call position for the next 100 odd days, where the maximum profit you can make is just this 2 points down here, from here to here. So this is the downside of rolling out and up once your strike is breached. But on the bright side is that you really kind of avoid being locked in a loss from where you first bought it, your 100 shares, to your covered call. All right, so that's for this method of rolling. Now the next method will be to roll out and up once the delta is roughly 0.8 deltas, right? So 0.8, basically you will be letting the price get in the money, right? Getting the stop price, let your covered call be in the money, and then what this does is that you're actually giving room for the stock to come back down, because there's always a chance that the market could go up and then it comes back down again later. So this way it could actually expire out of the money at expiration, and there's no need for you to adjust your covered call. So you won't be stuck with a covered call where you still have 180 days left to go. But the risk is that you could lock in a loss if the stock rallies too high, right? If it rallies too high down here, and at this point of time you realize that you cannot actually roll out and up. Instead, the only thing that you can do is to just roll out in time and keep the same strike price. So what happened is that you have essentially just locked in the losses at this strike price until the price do eventually come down, right? If it does come down and then your cover call just nice is in a profit, you can always close it out, right? So there are two methods, and there's no one that is better than the other. It always comes down to what the market does, right? What the market does, then by looking back, you will know that this might be the better one, or maybe this might be the better one. We never know. So if you want to be safer, you want to go for this one, right? Roll once it touches your strike price, roll out and up. If you want to maximize the extrinsic value that you get from the cover call, and you don't mind getting out for a loss, especially if maybe the cover calls is pretty near your shares, right? Maybe the cover call is somewhere here, then you can just let the stock just go into your cover call, let it go in the money around 0.8, then you can start to see whether it can roll out and up. All right. Now the alternative to just selling a normal cover call is that you could actually sell a cover call ratio spread. Now I've already created a video on this. I call it the enhanced cover call. You can watch this in my channel. I'll put a link also as well at the top right hand of this video. So for the cover call ratio spread, basically what it is selling a covered call and then having an embedded long call spread, right? You have an embedded long call spread down here, and then you sell the covered call at this same strike price. So basically this covered call, the premium which you receive, is meant to finance this long call spread. So if you sold the covered call, let's say for $2, then you can buy a debit spread, a long call spread, for less than $2, right? Maybe you can buy it for $1.80. So this way, net, you will have a premium of 20 cents, right? You collect 20 cents, is not much, but the difference with this and a normal covered call is that you do get to get the profits from the underlying capital gains, or the profits from this long debit spread. So as you can see, that this long debit spread is roughly about 5 points, which means to say you can make $5 on this spread. So if the market is to go above and closes above your cover call strike price, your shares will be called away at a loss of $5, right? You can see down here 105 to 100 is a loss of $5. But do not forget, because you have this long call spread, you're also making $5. So which means to say they actually net becomes zero, which means to say you could actually get out of this whole position for a scratch. You could even get, you know, whatever profits, right, whatever premium you have for selling this cover call ratio spread. So what you want to do ideally for this is to match the cover call ratio spread max profit, which is more than or equal to the loss on the underlying stock if the cover call is assigned. So in this case, compared to the cover call, right, if you see in the previous slide, our cover call has to be somewhere here or above this, and if it's called away, then we'll be at least at a scratch or a profit. But for the cover call ratio spread, we can have the additional short call, which is the cover call portion, below our entry price, and we can have it called away at this price because we also have an embedded long spread that covers the loss from this point where we bought it to where the shares will be called away if it's in the money at expiration, right? So for the cover call ratio spread, you want the stock to go up past your cover call strike to make money on your embedded long call spread. So this is an alternative to selling the cover call. So first of all, when we sell a cover call, right, generally we want to sell one that is above the current price with the objective of getting both intrinsic value and extrinsic value gains. So this is the cover call position. So basically you enter one when you enter into a shares position. So you buy 100 shares at the market and then you sell a cover call above the current price. So this way, when you sell the cover call, you'll be getting premium for this. So this is extrinsic value because you're selling out of the money. And then the intrinsic value gain will come if the stock actually goes above the cover call strike price at expiration. So this way your shares will be called away and then you'll be making the profit from the point of entry to where the cover call strike price is. So in this case, you have the double profits in terms of intrinsic value from this point to here, and then extrinsic value from the cover call. Now, what about the in-the-money cover call? So the in-the-money cover call basically means that when you place the 100 shares, you immediately just sell a cover call that is below the current price of where you bought the 100 shares. Now, when you take a look at this, immediately it kind of don't really make sense, right? Because you are selling your cover call below your entry price, which means that your shares will get called away at a lower price than where you actually entered. So at first glance, you might think that, hey, I'm buying at 88.69, but then I'm going to sell it away at $85. Wouldn't that be a loss? Now, it does seem like a loss, but actually when you're selling this in the money cover call, it already have the intrinsic value factored for. So that means when you get, let's say for example, if you do get called away, right, at this price, you actually do not make any loss on the intrinsic value because the cover call, when you sell it, it would already have this intrinsic value from this point, 85, all the way to 88.69. So in this sense, you're actually not losing anything in terms of intrinsic value. So the only thing you're seeking to gain is the extrinsic value portion of this cover call. Now, depending on where you sell the in the money, of course, if you sell one that's extremely deep in the money, let's say somewhere here, then chances are there's very little extrinsic value and kind of make little sense to sell it here, right? So I kind of understand why some people might want to sell a cover call that's in the money around this price, because what they want to do is they're trying to capture the extrinsic value of this cover call only. They only want to make money on this extrinsic value in case, right, if the market, you know, just goes somewhere, anywhere from this point to this point, right? Just anywhere this point, right? Excuse my drawings, but basically just this whole zone, anywhere above the cover call, that's what I'm trying to say. Okay, so let's try and investigate a little bit into this and see whether it is a good strategy or not. All right, so for this, let's simulate both the positions. So I'm going to simulate both the positions. So how it's going to work is that we're going to long 100 shares at the market, so it's at 88.69, and then we're going to sell one out of the money call at 92.5 for $2.14, and then we're going to sell the in the money call at 85 strike price for $6.18. So let's see which one is actually better, right? So if you take a look at the calls that I'm selling, this cover call. So first of all, let's take a look at the out the money call. So $2.14. So this is very straightforward. I chose these two strikes because they are pretty equidistant from each other from where the current strike price, or rather the current price of the stock is, right? So we have a kind of a rough gauge or measurement to see which is better depending on the different scenarios, whether the stock goes up or down. So based on this out of the money strike price, you can see that we're going to get $2.14 on the mark. So it's very straightforward. This is just all extrinsic value. Now, what about the in the money call, right? So this is where some people get confused, because if you sell an in the money cover call, wouldn't that mean that you actually are a loss? So I mentioned just now that it's actually covered in the intrinsic value. So if you were to see from $85 to 88.69, there's actually a $3.69 difference, right? This is the intrinsic value difference between the strike price of the cover call and where you long 100 shares. So if you take a look at the strike price of the 85 call, you'll notice that the intrinsic value is $3.69, right? It's just nice. This is the difference between these two strike prices. So you can see that if you were to sell this in the money call, you already take into account the intrinsic value that you would have lost if you get caught away here, right? So you have lost $3.69 if you get caught away at this strike price, but then by selling the cover call, you get back $3.69. So this is net zero. Mean to say there is no intrinsic value loss as long as it's above this cover call. Now the next thing is the extrinsic value. So you can see that the extrinsic value is roughly $2.50. So the goal of the in the money covered call strategy is to just simply get this extrinsic value down here. All right, so let's take a look at the different scenarios. So the very first scenario is that if Starbucks is above $92.50, all right, so this is the chart of Starbucks. So if the stock goes above $92.50, what's going to happen? Well, first of all, for the out of the money call, the cover call is going to get exercised. Right, at expiration, if it's above the strike price, you're going to get exercised. So the profit is twofold, right? You have the profit from your cover call, which you sold, and you have the profit from your intrinsic value gain from where you bought it and where your shares are being caught away. So the profit is, so this part is the intrinsic value gain. So from $92.50 minus off $88.69 plus the extrinsic value of your cover call, total you get $5.95, which is $595. All right, so now let's take a look at the in the money call option. So if you have the in the money cover call, same thing, as long as it's above your strike price, you're going to get exercised at this point of time, right? Your exercise price is actually down here. You're going to get exercised at $85 even though the price goes up here. So in this sense, you're going to be taking a loss, so to speak, on the intrinsic value of your shares difference from where the shares is and the strike price of this in the money cover call. But then you're going to add on to the value which you have gained from selling this in the money cover call, which is $6 and roughly 18 cents, $6.18 if you see this mark price down here. So if you notice, you actually make a profit of $2.49. So take a look at this, $249, and your extrinsic value is $2.49. So it's basically the same, right? So you notice all you're doing with an in the money cover call is that you're just trying to capture the extrinsic value of this option with a high chance of getting this extrinsic value, because for the shares, rather for the stock to be exercised compared this out of the money and cover call and this in the money cover call, is easier to get exercise on this in the money cover call than it is to get exercise on this out of the money cover call. So for scenario one, if the stock actually goes up, right, then it will be better that you sold the out of the money cover call, because you get the extrinsic value gain that is from this point of from this price all the way to here. For in the money cover call, you do not get this benefit. All right, now let's take a look at scenario number 2. All right, so let's take a look for the out of the money cover call. So if the price is somewhere in between these 2 points. Is actually below our out of the money covered call. So this means that our covered call, the out of money covered call, expired worthless, and the stock is either in a profit or a drawdown depending on where it is, right? So if it's above our entry price at this point of time, it could be quite ideal for those who actually do not want their stock to be called away, because your stock will be in a profit from this point to here. All right, you're seeing a slight profit. At the same time, your cover call expired worthless, so you also receive the premium from the cover call. Now, if the stock is actually below your entry price, so what will happen is that you will actually be in a slight drawdown, but then you still be able to get the full profits of your covered call. So we cannot really calculate the profit down here because you're not out of the position, right? You still have the 100 shares. So ultimately, this whole positions, whether you're up or down, really depends on whether the 100 shares go up in the end or it comes down, right? So for this, what we'll do is just calculate the premium which we receive. So the premium down here would be just $2.14. Right now, let's take a look at the in the money covered call. So for the in the money cover call, your cover call will be exercised because you are above this in the money cover call strike price, right? Anywhere above $85, you're going to get exercised, right? So what's the profit? So the same thing, the profit is actually exactly the same as scenario one. There's no difference if you take a look at scenario one, because you're just being exercised and all you're doing is just getting the extrinsic value gain. So in this case, if the market, all right, if Starbucks actually stays anywhere in between here, which is and above your in the money cover call, then it's actually better if you had sold the in the money cover call, right? Because you make more and you get out of the position. But then again, one thing you need to consider is your objective of actually getting into this position in the first place. Do you plan to hold this for the long term, or you plan to just capture only the extrinsic value down here, right? So if you plan to hold this for a long term, this could actually not necessarily be a bad thing compared to the in the money cover call, although you're making lesser here, because the stock may just be down here at expiration, but after expiration the stock could just shoot back up, right? But if you have the in the money cover call, you're out of this position, so you do not get to make money on the intrinsic value gain of your 100 shares. Now, but on the other hand, the stock could actually also go all the way back down after expiration, right? So maybe for the in the money cover call, you could have already been exercised, you're out of the stock, no positions, then the stock starts to tank. So if the stock starts to tank, if you sold an in the money cover call, you would say, wow, you're very lucky because you already got out of the position. Now as the stock goes down, you do not have to sit in for this ride because you're already out of it. But those with these 100 shares, if you sort of out the money cover call, the stock tanks, it's going to feel quite sucky, right? Because you're going to be seeing a bigger drawdown as the stock drops. Right, now let's take a look at scenario number 3, the last scenario, that is if the stock actually goes below the strike price of the in the money covered call. So which is better? Now the out of the money call. So the out of the money call, your covered call will be expired worthless and your stock is in a drawdown. So basically what I mentioned earlier, right? So your stock will be in a loss, you see in an open loss, and the only profit which you make, or rather the credit which you're going to receive, is rather just the covered call, right, which you sold, $2.14. So basically that's about it. What about for the in the money covered call? Now the in the money covered call will also expire worthless because it went below your strike price. So in this case, it went below your strike price, and then you'll still be holding on to the stock as well. You still have 100 shares. The difference though is that you actually collected much more because you sold your cover call for $618. So this is almost 3 times what it is for the out of the money call. And in this case, your drawdown, because of your cost basis is going to be lower because you have this $618, your overall drawdown, your net drawdown, is not going to be as big as this out of the money call. So in this case, if the market actually goes down below the in the money covered call strike price, then you would actually be better off if you had sold the in the money covered call. So is the in the money covered call a viable strategy? So I've shared with you all the 3 scenarios and compare both of them side by side. So is this a viable strategy? Is this a good way for you to be, making money in the long term with an in the money covered call? So here's what I think. I think that the in-the-money covered call can be a viable strategy given the right situation and also given the objective you have when you actually get into this position. So for example, if you plan to buy 100 shares, right, to long 100 shares and then sell the in-the-money covered call at the same time, right, it will actually be cleaner to just sell an out-the-money put option, right? If you sell the put option that's out of money at the same strike price, it's actually synthetically the same position, right? If you take a look at this, this is the in-the-money covered call. You long the 100 shares and then you sell the covered call that's in the money, and then you sell an out-the-money put at the same strike price, right? So let's go back to this chart again. So instead of selling this in the money cover call, right, all you're doing, and you do not buy this 100 shares, all you're doing is just have to sell this put option at 85 strike price. And if you were to take a look at the put option at the 85 strike price, it's actually roughly the same premium that you will receive as this extrinsic value down here. Right, so there's really not much difference. So if you take a look at this risk profile, they're pretty much the same, right? Just only a few dollars difference. Okay, so the reason why you want to do a short put, selling an out of the money put option rather than go through the hassle of, just buying 100 shares and then selling in the money cover call at the same time, is that there's actually much less buying power needed with the out the money put, right? You do not have to commit the capital to buy the 100 shares, all right? And then you just only have one leg as opposed to two. With the in the money cover call position, you need to buy 100 shares, you need to sell the cover call, so it gets quite clunky compared to if you just to sell one put option and then you manage it so much easier, right? And for the put option, you can just keep rolling the put option down. So if the market goes below your strike price, you can just keep rolling again. You can roll it out or you can roll it down. Now with the cover call, it's going to get a little bit messy and you don't want to really get through all the hassle, trying to figure out how to maintain this position as the stock drops, right? So if you plan to just sell an in the money covered call immediately after you have bought the 100 shares, then I would just suggest that you just sell the out of money put option because it's pretty much the same. Now, if you don't mind exiting your stock position, then it could be viable, right? It would be a viable strategy to sell in the money cover call when the stock is overbought. So if the stock goes up, so this is assuming that you actually hold on to the stock as the stock goes up first before you sell the in the money cover call. So that means you buy the 100 shares here, all right? You hold on to it, and then let's say the stock comes down here, and then you bought the 100 shares, so you hold on to it. You do not sell the in the money cover call first. You wait for the stock to go up, so this way you actually are in profit on your stock. Then you sell this in the money cover call, right? In this case, you will be also making money in terms of the intrinsic value gain from where the stock price is to where the in the money cover call is, right? So this would make much more sense to me to sell the in the money cover call. So by this way, you actually secure your exit price at the current price if the stock stays above your in the money cover call. So this is where the current stock price is. If you sell the in the money cover call at this price, remember your cover call would have really compensated you for this intrinsic value loss if you were to be called away here. So basically, you're just securing this exit price already, right? Because your cover call intrinsic value would have already accounted for this. So all you're doing is that you're going to get the extrinsic value on this cover call. So that is why I say here, you also get the extrinsic value portion of the in the money cover call. So if the stock drops below the in the money cover call, you don't have a huge credit to offset the drop in the stock. So I actually have a chart down here for you to see what I mean. So for example, if you were to buy the stock down here, you hold on to it until the stock goes up down here, and at this point of time, you take a look at your stochastics, and then you see that the stochastics is overbought at this point of time. So at this point of time, when the stochastics is overbought, it doesn't mean that the market will come down immediately. There is a chance that the stock can still continue going up even though it is overbought, right? So this is just an indication. But when there is an indication of it being overbought, it just means that there is a higher probability that it could come down compared to it going up. So if you're afraid that the stock could start to come down and you do not mind getting out of the position and you want to secure this current price, on top of that, you also want to get the extrinsic value, right? This extrinsic value of $2.50 down here that comes together with this in the money covered call, then you can sell the in the money covered call, right? So this way, what you're actually hoping is, let me just remove the drawing. So what you're actually hoping when you're selling the in the money covered call is that the stock price would ideally stay above this covered call, right? So this way that you would be called away on your shares, and then you still be able to get this nice premium. At the same time, when you sell the in-money covered call, again, you will still be essentially getting out at this current price of 88.69 because of the intrinsic value gain. And if the stock was to drop below your covered call, that means you do not get exercise and you still hold on to the shares, at least you still have a big compensation in this case, right? Because you're receiving quite a big of premium compared to if you were to sell the out of the money covered call, where you only receive, you know, $2.14, right? So if the market drops below your in the money covered call, we have already seen that it's actually better for you to have, you know, the huge premium you get from in the money covered call rather than selling the out of the money covered call. Now, if you're worried in the first place that it will continue to drop even more, and you don't want to wait all the way to expiration to see whether, you know, it will expire above your cover call, what you should do is that you can just sell away the stock outright, right? You can just sell at 88.69 without even selling any covered call. So this way, if the stock actually goes down after that, you don't have to worry, you know, you should have sold it earlier on or what. So this is my take on the in the money covered call. So it can be viable given the right situation. But again, if you are selling the in the money covered call strategy at the point of time when you're actually buying the 100 shares, then I would suggest that you just sell the out of the money put option because it's exactly pretty much the same. What if you had already bought the 100 shares, right, and then you held on to it, right? So you held on to it until the stochastics indicator is showing an overbought signal, right? So when the stochastics is showing an overbought signal, it just means that there is a higher chance, a likelier chance that the market will go down compared to it going up, right? Now, of course, it is not guaranteed that the market will immediately go back down after issuing an overbought. It just is a probability thing. It's a measure to say that the market has a higher chance of it probably turning down compared to it continue to go up. Now, if you see the previous times when the market was showing an overbought signal, you can see that it has been overbought for quite some time. The market just kept going up, right? So in this video, we want to compare which is better, right? Do you want to sell an out of the money covered call, or do you want to sell an in the money covered call when the stochastics or any indicator that you're using that shows overbought or oversold, right? So if any of this indicator is showing overbought, should you be selling an out of the money covered call or an in the money covered call, right? Which is better? So if you have watched the covered call blueprint on the strike selection, which I talked about previously in my channel, you haven't watched that, again, please go ahead, watch that first. What I mentioned then is that if you want to avoid your covered call from getting assigned, then you want to sell your out of the money covered call, right? Of course, it is not guaranteed that you won't get assigned. It's just that you will have a less likelier chance to get assigned, right? For the market to go up above your out of the money covered call and expire there, there's a less likelier chance compared to if you see the indicator, right, the stochastics is oversold and then you sell the covered call, right? So for this video, should we be selling an out of the money covered call or should we be selling an in the money covered call? Which is better when the stochastics is overbought? So the question I want to put to you is, what is your primary objective to hold the stock long term, right? Because this is the most important thing you want to understand, because some people get into this covered call positions. The reason which you're getting into this position could be very different from somebody else. So for me personally, when I get into a position like this, most of the time, what I want to do is basically just hold on to this 100 shares for a very long time, right? The idea is that I do not want to have my covered call assigned. I do not want to have my shares called away. So that is why I'm very selective when I sell my covered call. I do not sell it all the time. Most of the time, I just wait for it to be overbought and sell a out of the money covered call. Now, what if that is not your primary objective? What if your objective is just to sell the covered call to get an income, right? So if your primary objective to hold the stock is for the long term, that means you want to hold it for a very long term without having it called away, you want this to be a long-term investment stock portfolio, then I would say that yes, you want to sell the out of the money covered call, right? The pros is that you have a lower chance of having your stock called away and you still get an income on the covered call, right? So the main driver for you, if you are planning to sell an out of the money covered call, is the capital gains on this 100 shares, right? So this covered call premium which you receive is just additional, but your main driver of profits is this capital gain from your 100 shares of stock. So if that is your motivation for buying the 100 shares, then you want to sell an out of the money covered call. So this is the pros. Now the cons is that if the market tanks, right, you do not have that big of a cushion to the downside compared to the in the money covered call. So if you sell an in the money covered call, right, let's say for example you sell it somewhere here in the money covered call and the market goes down, right, in both cases your covered call is not assigned. That means you still get to keep your shares, but you would have been better off if you sold the in the money covered call at this point, right, because you would have a higher premium. A higher premium will help you cushion the downfall. Maybe it's temporary. If you bought a good stock or maybe you bought an index ETF, right, it can go up in the long term. So if that's the case, you'll be getting a bigger premium to help cushion this temporary drawdown. Now, what if your objective is not to hold the stock long term? Your objective is to just get the covered call income, the premium from it, and just keep doing this over and over again, just to rinse and repeat. So if that's the case, then yes, go ahead to sell the in the money covered call, right? So the pros of this is that you get to secure your intrinsic value gain at the current price if the stock is above the in the money covered call at expiration, and you have a big credit to cushion if the stock is below your in the money covered call at expiration. So basically, when you sell the in the money covered call at this point of time, what you're actually doing is also securing this exit price down here at $89.07, because as I alluded to in the previous video, and if you look at the option chain, when you sell this in the money covered call, you'll notice that the intrinsic value portion, the column of this covered call, it would be the difference between this current price and your strike price, which means to say that when you sell the in the money covered call, you really have the embedded difference of this intrinsic value from this point to this point, which means to say you won't actually lose any intrinsic value. All you'll be getting is this extrinsic value from this covered call. So what you're essentially trying to do is that you want to get the extrinsic value from this in the money covered call. At the same time, you want to ensure that there is a higher chance that the market, or rather that your covered call, will get assigned. Because if the market was to go somewhere down here at expiration above your in the money covered call, if you had sold the out of the money covered call, right, your this out of the money covered call would not be exercised, right? Your shares will not be called away. But in this case, your shares will be called away, and then you'll be still getting the intrinsic value difference from this point to this point, because your in the money covered call already has the intrinsic value embedded into it. So it's essentially you selling off at 89.07 and then still getting the additional extrinsic value. So at this point of time, you have no position. You can go on and put on another covered call position again, right? Or maybe you can just buy a shares, wait for the stock to go back up, and then you sell another in the money covered call. So in this case, if you just want to go for the income, you want to be in and out, you have no desire to hold on to the stock for the long term, then yes, selling the in the money covered call would be actually very good. Now, the cons is that the stock could continue going up and you miss out on more intrinsic value gains, and the stock may not come back down again. So for example, if you had done the in the money covered call at this point of time, let's say you can see that the stochastics is overbought at this point in time, and then you sold an in the money covered call, let's say somewhere down here. Now as you can see, the market has just rallied from that point on. Had you sold an out of the money covered call, let's say somewhere down here, you still would get exercise, but you would have the difference of this intrinsic value gain from here to here. So you basically missed out on this intrinsic value gain over here. So this is where you want to weigh the pros and cons. Now there's no one that is better. It all comes down to what the market does after you have placed the covered call, or whether you are good at timing the market. If you're good at timing the market, then of course you can place your covered call where you think the market will be headed. Now, but Davis, can't I just sell the in the money covered call and get my shares called away and buy the shares again once the stock goes lower? So that means your intention is to sell this in the money covered call And then maybe you think that because it is overbought, the market could come down, but not as low as your in the money cover call. You won't go below your in the money cover call. So this way you get exercised, and then you still secure this intrinsic value gain, the exit at this price, and it will be better than if you sold the at the money cover call, right? So at this point in time, you're waiting for the stock after your shares have been called away. If the stock goes down again, maybe to the original entry price, then you want to buy again. So is this a good strategy? Now, of course you can, right? Absolutely you can. That is if the stock goes low enough to where you want to buy the stock again. Because what if you are assigned, your cover call has been assigned, your shares has been called away, and from this point, the stock actually goes up. So where are you going to enter the stock? Are you going to buy at a higher point, or are you going to buy immediately once your shares get caught away? So these are the decisions that you have to make. So again, of course, it would be fantastic if the stock immediately drops after you had your shares caught away, and then it goes back to the original entry price, you buy again and do this again, and you just keep making the money this way, right? Now, next thing you want to keep in mind is that remember that overbought is just an indication. It can continue to be more overbought as the stock continues to go up, as you can see down here. Okay, so if you prioritize income, then you can go with the in the money cover call. Right, so all you're doing is you want to have a high chance of having your shares caught away so that you get the extrinsic value, and then you do this position again. But if you prioritize capital gains, or you prioritize, wanting to hold on to the stock for the long term, then you want to go for the out of the money cover call. Now, the alternative is to sell an at the money cover call. That means at this current price, what you want to do is you sell the cover call at this price as well. So you'll be selling the cover call exactly at the same price where the market is. And for this, if the market goes up, right, you will be called away, which is what you wanted if you wanted the income. But this way you get actually more extrinsic value. But if the stock actually goes down, at least you still have a bigger credit to cushion this downfall compared to if you sold the out of the money cover call up here. Right now, of course, it may not be as good as the in the money cover call, but then again, who knows where the market will go, right? So it ultimately comes down to, whether you're able to time the market well, or or you have an intuition on where the market is going to go. So David, since the stock is overbought and it has a higher chance of it going down, can I sell a slightly in the money cover call using the weekly expiration cycle, so there's a higher chance of it expiring below the in the money cover call, and I get a big credit and still get to keep my shares? Wow, that's a mouthful. So I think what your idea here is that if the stock goes below your in the money cover call, right, you still be able to get the huge credit down here, and because you're selling the weekly expiration cycle, that means probably around 7 days or so or less, for a higher chance, there's a higher probability, because the market now is overbought, that the market will come down in the short term, rather than you sell a maybe 30 days or 45 days in the money cover call, out the money cover call, where the market may bounce back up, right, sometime within the 45 or 30 days. So what you're trying to do is trying to capture this move down here, that you want to get this premium down here because you think that the market is going to go down. So I do think that this is actually a pretty good strategy, a very good idea if you can really time the market well. Because what you're trying to say here is that you're predicting the market will definitely go below this in the money cover call, so you earn the income here and you still get to keep your shares. Now, of course, if it does that, then yes. But again, you need to remember that there's a higher chance, right, with the in the money cover calls, that you will have your shares caught away compared to out the money cover call. So if you're prepared that there's a possibility of your shares being caught away, then this would be a good idea. So for example, what if the stock didn't go down? You see it's overbought, like for example, all this times down here, it is overbought, the market kept going up. So there's a possibility that what if it didn't go down? You had this idea to just capture more premium for the in the money cover call, hoping that the market will go below this point of time, expire worthless, you still keep your shares. But what if the market continues to go up? So if the market went up, what will happen is that you will be called away at this price, and then the next question you're going to ask yourself is, how are you going to get back in, right, if you still want the stock? So maybe that time you may have to wait for a retracement, or you just buy as it goes higher, right? So all these are the questions you want to ask yourself. Again, there's always a trade-off. Now, Davis, for out of the money covered calls, you mentioned about selling 30 to 45 days out. Yes, that's right. If you watch my cover call strike selection blueprint, I talked about selling the cover call, 30 to 45 days out. Now, what about selling the weekly expiration cycles? Is it a good idea? So my personal opinion is that yes, selling the cover call in the weekly expiration cycle is definitely feasible, and you can get actually a higher return on the call option. So when I talk about higher return on the call option, I just specifically mean the cover call premium, right? So remember, when you're selling the cover call, or rather the cover call position consists of the 100 shares plus the cover call. This is what you call a cover call position. If you do not have this 100 shares, all you have is a naked call. So it's a totally different position. So a cover call position consists of the intrinsic value gain, the potential intrinsic value gain from the 100 shares. So I do think that the weekly expiration cycle is definitely feasible if all you're trying to do is get a high income from the cover call, and you're not interested, or rather the main driver of this profits is just the cover call premium instead of your 100 shares intrinsic value gain. So if that's the case, yes, you can definitely sell the weekly cover calls. And in fact, that's what I do for the wheel strategy, where I have multiple entry levels. So for example, I use the wheel strategy in a slightly different fashion than what most people do, especially now because it's in a bear market. The market tends to want to go down over time. So most people would just have one entry level, and then after they've entered it, they either sell the cover call at the entry price, or they finally wait for the stock to go back up before selling the cover call. But for me, I like to prepare it in a different way, where I try to plan for the worst scenario that can happen. So for example, if I want to get into this Starbucks, and I think that the market is going to go pretty far down, what I'll do is that I'll split them into different levels, right? I will sell cash secure put at many different levels. Of course, I've already allocated my capital, right? I've got a pretty decent sized capital, so that is why I'm able to enter into many different levels. So what I'll do is that as each time it comes down to the level, I will sell the weekly cash secure put, so that I get a higher return on the cash secured put itself, on the premium. So as it goes down, I get 100 shares, right? I will wait for it to go back up, and then I'll sell the weekly covered call again. So because the levels in between each of this, the interval level is quite close to each other, I do not need to sell the 30 to 45 days out, right? Generally, I want to sell the 30 to 45 days out if I want to get a further away strike price, right? So for example, let me just remove all this drawing. So let's say, for example, the price is down here right now. I want to sell the 84 strike price. Now, if I were to go to the weekly, I wouldn't be able to sell this for much premium because it's just too far out of the money for the weekly, right? But if I will go to the 30 to 45 days, the monthly cycle, then this 84 would have a decent premium for me to sell. So if I'm only going for one or two, or maybe at most 3 levels where I space them out, right, pretty far apart, maybe I can go up to 5% or more, or maybe to 10%, again depending on the individual stocks. If that's the case, then I would go for the monthly cycle, right? But if it's very close distance, which I have in between them, I'll go for the weekly. So the same thing for the cover call, right? So you definitely can go for the cover call weeklies, but keep in mind that while the return is higher, right, your absolute amount which you receive is going to be lesser in terms of the numeric amount, right? And also the strikes are closer to the current price. That means your intrinsic value gain will be lesser if the stock is above your cover call expiration. So for example, if you, let's say you're targeting $1 in terms of premium, for the weekly you may just get somewhere down here, right? Probably close to this current price. But if you look at the monthly, if you get $1 premium, right, you may be able to sell somewhere $96, much further out of the money. Right now, you might be saying that the $1 is too little in terms of premium. Why do I want to sell, $1 only, or it's so far? Then, as I mentioned, remember the cover call position is consisting of this long 100 shares. So this is the main driver of your profit. All right. So if you were to sell the weekly, your intrinsic value gain will only be up to here, but for the monthly, your intrinsic value will be much higher. So again, it comes down to which one you want to prioritize. If you want to prioritize income, then yes, you can go for the weekly. You can sell it over and over again to get a lot of this premium over time. But if your priority is more towards the 100 shares, the intrinsic value gain on this, then you want to go for the monthly. So let's say we are interested in buying Amazon, and Amazon we think is at a good price. We think we want to buy at this price, so we say, all right, we're going to buy 100 shares of this. Now, instead of just being a traditional buy and hold investor, right, we want to be a savvy investor. So as a savvy investor, what do? Right, we sell a covered call. So with a covered call, we are going to receive an income while holding on to this stock until it eventually goes up higher, right? So when we sell a cover call, we'll be receiving this premium. As you can see, it's $1.74, which is $174, and we sell it at 135. So 135 is a pretty decent place to sell because it's not too near, all right, to the current price, and it's not that far away that we don't get enough premium. So we sold at 135. Now the dilemma is this, right? So we have a covered call, but on the other hand, we have a stock, right? So our mindset right now is that we do want the stock to go up, right? So because we have a stock, we want the stock to go up. That's how we make money on the stock. But on the other hand, because we have a covered call, we do not really want it to go up so much, right? So we have this sandwich mentality right now. I call this a sandwich mentality because we're squeezed in between this area right here. So we are sort of like telling ourselves, I want Amazon to go up, but please go up slowly. I want it to go up slowly so that when it reaches this point, just stay there for a while until our covered call expires. Then you have my permission to shoot back up, right? So this is the kind of mentality that most people have when they start selling the covered call, because they kind of hope that it does not go past their strike price. And if it goes past this cover call strike price, they kind of panic because they see their cover call is losing money and they think, what's happening? What's going to happen? So this is the mentality which we have if we sold the cover call. Now, on the other hand, if you didn't sell the cover call and if the market went all the way down, then you will be telling yourself, I wish I had sold the cover call. Damn it, why didn't I sell the cover call? Because if I had sold the cover call, I would at least receive some money to cushion the downfall before it eventually comes back up. So this is the sandwich mentality that I call. So this is kind of a little bit of the dilemma that people who are selling cover calls have. So during this time, back then, when I sold this cover call, I kind of asked myself, is there a way that I can improve my psychology when I sell the cover calls? Because I do want the stock to go up, but then again, if it goes all the way up too high, I kind of start to feel, the regret of selling it. So I asked myself if I could incentivize myself, what is a way I can incentivize myself to say, hey, I'm okay if the stock actually goes past my cover call, and in fact, I want it to happen. Right? So the way to incentivize myself is if I told myself that, I want to get paid even more if the stock goes above and have my shares called away. So how do you do that? So the way to sort of incentivize yourself, right, for the stock to go past your cover call strike price is to actually to buy a bull call spread. So a bull call spread very simply is just buying a call option at a lower strike price below your cover call, and then selling a further out of the money call option, and you can sell it exactly at the strike price of where you sold the cover call in the first place, right? So you can see you're using the premium from the cover call to finance the purchase of the bull call spread. So this way, this bull call spread is 100% free, right? So how does the bull call spread work? So it works is that if anywhere where the stock goes to above this long call leg, we will make additional money, right? So that is how I thought to myself, if the stock is to go up, I don't mind it going all the way back up, because as it goes up, I actually make more because I have this bull call spread. And when you use this to finance this, you combine this together, it becomes what is called the covered call ratio spread. So this is just a call ratio spread, and it's a covered call ratio spread because you have 100 shares on it, right? So if the short call get exercised, your shares get called away. So you notice that if you route this covered call ratio spread, you actually also get a credit, right? Because the bull put spread which you bought is lesser than the premium which you receive for selling the covered call. So this way you actually receive a credit in case if the market actually just goes down, right? So if the market goes down, right, it's not like you get nothing. You still get some money, although it's not as much as the covered call. But if the market goes up, the stock goes all the way up, suddenly I don't find myself, thinking to myself, say, please do not go up, please stay below the strike price. But instead, I find myself thinking, yes, I want it to go up, because if it goes up, I make the full profits on this bull call spread. And at the same time, it's still possible that if it goes up, I could sell away the bull call spread and then roll my cover call up again. So this way, my shares, I still keep it, and then I get the full profit on this bull call spread, right? So let's go through a few scenarios to compare both of them, right? Let's compare the cover call with the cover call ratio spread and determine which is better. Okay, so the first scenario is if Amazon is below $130 at expiration. So below $130, that's below our long call leg of the the bull call spread. So anything below here, let's see what happens to both of them. So first of all, for the covered call, it expires worthless, right? So if it expires worthless, we get the full credit, $1.74, which is $174. All right, what about the cover call ratio spread? So the cover call ratio spread also expires worthless, and we only receive the credit, and that is $43. So as you can see, we do receive some money, but it's lesser than the cover call if you were to just sell the cover call by itself, right? It's lesser by about $131. All right, so this is for scenario one. Scenario one, we would have been better off just by selling the covered call. What about scenario two? Now, scenario two is if Amazon is in between $130 and $135. So this is in between our bull call spreads, right? So how much does the cover call make? So the cover call, again, makes $174. There is no difference between what you make for the cover call because it just expires worthless. It doesn't go above 135. What about the covered call ratio spread? So the covered call ratio spread really depends on where it closes at expiration. So let's say if it closes at $131 at expiration. So in this case, the covered call ratio spread, the profit is you take basically the price where it closed at minus off the long call leg at $130, so that's $1, and then you add the credit which we had initially for selling this call ratio spread. So the total is $143. So as you can see, it's actually not much difference to if you sold the covered call just by itself. We just have a difference of about $31. Now, what if, right, it went higher? What if Amazon actually went up to $133? So if it went up to $133, the profit is $133 minus $130 plus the credit. We sold it again. That is a total of $3.43, which is $343. So now, wow, you see, we made more than what we would have if we had sold the covered call just by itself, right? So we made almost double the profits, right? And the cool thing about this is that our short call, right, the cover call which we sold at, was not breached. That means we still hold on to our shares. So we hold on to our shares and we have an additional $343, and at this point we can sell another covered call or another covered call ratio spread. So if the stock went up to 133, then the covered call ratio spread would have been better than just selling the covered call. Now, what about if Amazon actually went above our cover call strike at 135? If it goes up there, what happens to both of them? Right, so first off, the cover call, it would get exercised, and our profit, again, it doesn't change. Our profit is just simply the premium which we sold it for, which is $174. So now we want to calculate the effective exit price, because remember, we assume that we bought it at this price, which is at 122.42. Now, if we exited at 135, which is where our shares got called away because of the covered call, we want to add the premium which we receive, right? The profit. So it's $1.74. So that means our effective exit price is $136.74. So this is the effective capital gain on the full position, or as though that we just bought our stock, right? Without a covered call, this is where we would have exited to match this profit. So it's $136.74. Now, what about the covered call ratio spread? So the covered call ratio spread, right? First of all, the profits, we will make the full profit on this bull call spread, which is $5, right? The spread is 5 points, so it's $5, and we add on the credit, 43 cents. That is a total of $543. So this is significantly more than the credit which we would have received if we just sold the covered call. So what is the effective exit price? So effective exit price is we take 135 is where we had our shares called away, and then we add the profits of $5 for 3 cents. So that gives us an exit price of $140.43. So check this out, right? It is so much more, it's higher than at 136.74. And here's the thing, right? So let's say, for example, Amazon actually went up to, let's say, 137.50, and that's where our cover call expires. So this is where it got exercised, right? So at this point, if we had a cover call ratio spread, we actually had a better exit price than if we had just, held on to the stock. If we held on to the stock, our exit would be 137.5, assuming we exited at this price during the options expiration date. But had we sold the covered call ratio spread, right, our effective price is actually higher. So that means we actually gained even more rather than just holding on to this stock on its own. So as you can see, if the stock went above our cover call strike price at 135, let me just remove this. If it went above our cover call at 135, right, the covered call ratio spread would have done much better than the covered call. So you might be wondering to yourself, after I've showed this to you, which is better, right? Should you go for the cover call or should you go for the cover call ratio spread? So the answer is this, right? Listen carefully. The answer is it depends, right? So it really depends on where the stock actually ends up, right? If the stock goes below and both expires worthless, then of course the cover call would be better, right? Because you'd be getting more. But if the stock actually went up, close above our 135, and we would have our shares called away, then it's of course better if we had sold the cover call ratio spread, because we made more and our exit price would be higher. So unless you have a crystal ball, right, you know where the price is going to, and if you really do, please contact me, I'll buy one from you, right? But if you don't have one, then you want to choose the option strategy, either the cover call or the cover call ratio spread, the one which you feel easier for you to take in the psychology. Because remember again, if you were to sell the cover call by itself, you will have this sandwich mentality, right? This sandwich mentality is you're telling yourself that, I want it to go up, but please don't go up so far, so high, just wait until my cover call expires, then you can shoot up. All right, so that's the mentality with the cover call. But with the cover call ratio spread, I would tell myself, if it's going up, I would say good, continue going up, because I will be compensated for this move. If you go up, I will get an additional $5, right, on this bull call spread. So at the end of the day, it comes down to also your psychology on which one you feel more comfortable, right? So you just need to understand the trade-off between the two. If the market goes down, then of course it is better to sell a covered call by itself. But if the market was to go up and you're afraid to have your cover call breached, then it would be better to sell the cover call ratio spread. And again, remember, even though you have the cover call ratio spread, and if it goes above your strike price, you can always take the full profit, or rather most of the profit of the bull call spread, and then you can roll your short call option out and up in time, right? So this way you can continue holding on to your shares and still make quite a good profit on your this bull call spread. what is a poor man's covered call? So let's start off with what a normal covered call position is. So a normal covered call position is just simply buying 100 shares of the underlying stock and then selling your covered call, which is a short call option. So what is the poor man's covered call? So the poor man's covered call, instead of buying 100 shares of the underlying stock, we buy a deep in the money call option, right? So this call option can have an expiration, anywhere from 3 months to 6 months or even longer, right? I personally like to buy a deep in the money call option on leaps, which is a year or longer, right? So this way I have a longer time for the trade to work out in my favor. And then we still sell a covered call. So the reason why it's called a poor man's covered call is because it is much significantly cheaper than a covered call position, right? So many people, when they start off trading the options, right, they may not have 100 shares, or rather have the capital to buy 100 shares of the underlying stock. So instead, they can use lesser money to buy the deep in the money call option. This way you can still have a very similar position and in fact have a higher return. So let's take a look at it on the charts and see how it looks like, right? So this is the chart of Starbucks. So let's just say we're going to initiate a covered call position. So to get into a covered call position, well, first of all, we're going to buy 100 shares, right? So 100 shares at $83.59 would cost us $8,359. And then let's say we sell a covered call at the 88 strike price, right, with a DTE of 25. So we could get about $1.20 for this, all right? So $1.20 is $120 because each option has 100 shares. So let's calculate the return of this. All right, so the annualized return is just simply you take the premium which you receive, $120, you divide it by the cost of buying the 100 shares, and you divide it by the number of days for the covered call, right? Because this covered call will expire in 25 days, then this $1.20 will be realized profit for us. So we divide it by 25 and we times 365 days. That gives us an annualized return of 20.96%. So it is not bad, right? So this is not considering the price movement, right? We haven't considered whether the price will be going down or the price will be going up, right? So this is just merely the return of this covered call on the cost of the shares. Now let's compare it with the poor man's covered call. So the poor man's covered call, instead of buying the shares, we're going to buy a deep in the money call option. So in this case, I've used the call option, which has an expiration date of 543 days left to go. So for this, we can get it for $3,995. Okay, so $3,995, you can see, is significantly lesser. In fact, it's less than half the cost of 100 shares. So next, same thing, we would sell a covered call. So assuming it's the same covered call, and then we receive $120 for it. So what is the return? So the return, similarly, we take $120, but this time we divide it by the cost of this long call option, which is only $3,995, divided by 25 days to expiration, and then we times 365 days, and this gives us a return of 43.85%. So as you can see, just from the covered call alone, we've already doubled, right, our return. Right, we have already doubled our return on the normal covered call position. So that is why the poor man's covered call is quite a popular option strategy among a lot of people, because you can get a very high return and the risk is kept, right? Your risk is less than half you would if you buy 100 shares. Okay, so what about if the stock was to go up or the stock was to go down? What is the difference between the profits and loss between the covered call and the poor man's covered call? So let's head over to my trading platform to show you the difference. So as you can see, let's take a quick look at how Starbucks is doing since the screenshot I took. So when I took the screenshot, Starbucks was around $83.58. Right now, the market has dropped a little bit lower. So let's take a look at the option chain and see how we can construct both the covered call and the poor man's covered call and compare it to each other. So the first thing I want to do, right, we go to the option chain and then we want to take a look at which is the covered call days to expiration where you want to sell it, right? So let's say I want to go at 25 days. Okay, so if I want to initiate a covered call position, it's very simple. I'll just go to the strike that I want to sell the covered call at. So let's say in this case, let's go for the 88. All right, so what I do is I will right click it. I'll say analyze buy trade because I want to analyze the risk profile, and then I click covered stock. So you can see if I click covered stock, you immediately populate this order ticket. You have 100 shares, you buy 100 shares, and then you're selling the covered call, this call option, at the strike of 88, and then it's a debit for $80.56. So that's $8,056. All right, so let's take a look at the risk profile. So you can see this is the risk profile at expiration, right? At expiration date, this is how the expiration of the covered call, this is how the graph will look like. So we have two lines down here. So this is to just indicate how much you will make or lose if the market goes down or up. So right now the current market price is where this if you can see this goal line is somewhere around here, all right, around 80.6, around there. All right, so if the stock was to go to $70, how much does it lose? All right, this is a covered call position. If it goes to $70, you can see it loses $1,056. All right, and then if it goes up to $90, it makes $744. So let's compare this to the poor man's covered call. So for the poor man's covered call, same thing, I'll find the strike which I want to sell the covered call at, right? Analyze by trade, but this time I will click the diagonal, right? So this poor man's covered call in essence is actually just a diagonal spread because you're buying and selling two different options from two different expiration date. Now it will populate the next available option calendar date that you can go to, but in this case we don't want to use this. You want to go slightly further out, right? Generally you want to go for somewhere around 180 days or further. I like to go all the way to the furthest because I tend to see this as a longer term investment, a longer trade. So in this case I will go for the 19 January. I'll just adjust to 19 January 24. Now the next thing you want to do is try and see which strike that you want to actually buy. All right, so again we want to go for the deep in the money ones, right? So we're looking for deltas that is above 80, right? The higher normally the better, but you also want to see how much you'll be paying for it, right? Ideally I like to pay at most, or rather ideally I want to pay at most half of what the cost of 100 shares would be. So 100 shares at this point in time will be around 8,100. So I like to pay around $4,000 for it. So around this strike 40 or strike 45 would be ideal for me. All right, so let's say we go for the 45 strike price. So I'll shift this to 45. So you can see if you were to buy the 45 long call and you sell the 88 strike price for the cover call, you only pay $37.36. So that is $3,736, right? That is less than half of what you're paying for 100 shares for the cover call position. Now, the reason why we want to go in deep in the money call is because of this number down here. So this is the extrinsic column. So extrinsic value is very important if you want to buy and sell options, right? You need to understand what is extrinsic value. So this is basically time value, and this will all go down to zero at the end of the expiration date. So as much as possible, when you're buying options, you want to buy as little extrinsic value as possible. So you can see if you go all the way far up, there are some people who are saying that you can go ahead and buy the long call option at a cheaper price, right? You can go out of the money, right? You can even go to 90 strike price and you only pay $9.20. All right, the mark is $9, so you only pay $900 to control 100 shares roughly at this price, $81, right? But the problem is that you are actually paying mostly extrinsic value. Extrinsic value at the end of the day, it will go to zero. So just to give you an idea where the stock has to go, right? $90 is the strike price, and if you are paying $9 for it, right, it means the stock has to go up to $99 by the time this option expires, or you lose everything that you paid for, right? So you can see now it's only $81. For it to go to $99, that's almost $20. So it has to move $20 out of $80. So that's about 25% return, right? You need to move 25% for you to break even, and you haven't made money yet. So that is why I always prefer to buy a dip in the money, the call option, if I'm buying an option, right? So you can see the extrinsic value is much lesser. So this way you actually do not have a huge decay, and you're paying relatively lesser. And don't forget, you're having the covered call to offset your extrinsic value. And ideally, I want to sell a covered call that can fully offset this extrinsic value in either the first covered call or in the next 1 to 2 covered calls. So if you recall, the covered call that we sold, all right, or we are intending to sell, right, as an example, is 88. So this 88, we can get roughly 72 cents, right? 72 cents, and we have gotten the 45 strike. So 72 cents minus off $1.79, so there's roughly left $1.07 left. So if I can do this for another 2 times, it means I've completely removed the extrinsic value risk of this option and even eat into the intrinsic. That means if the market just goes back to where it was when I first entered this position, I still make money because of the covered call that I've sold, right? So all right, so the poor man's covered call position, let's take a look at the risk profile compared to the normal covered call position. So again, first of all, let's see again what is the loss here. So at $70, the loss is at $1,056. So let's take a look at the poor man's covered call. Now you see the poor man's covered call loss is lesser, right? The loss is only $892. But what about the profits? All right, the profits is $744. And what about the profits for the poor man's covered call? The poor man's covered call profit is lesser. So you can see the risk is lesser, the loss is lesser, but the profits is also lesser. But then let's calculate this in terms of return, right? Because we always want to see it in terms of percentage wise, how does it do? So let's first start off with the covered call, and let's bring up our trusty calculator here to take a look at in terms of the profit, right? So let's say we have a profit of $744 at expiration date of the covered call. It went up to $90, right? So we take $744, we divide it by 8,056. So the return is 9.2%. All right, and let's just keep this simple. Let's not annualize it. That means we don't divide it by the days to expiration for the covered call. So this is just simply 9.2% on this profit over the cost of your stock, right? So 9.23%. Now let's take a look at the covered call, the poor man's covered call position. All right, so the poor man's covered call, we have a profit of $615. All right, let's just round it down. $615. We divide it by the cost, $3,736. So you can see we have a return of 16.46%. So with the covered call, we have 9.2%. And with the poor man's covered call, we have 16.46%. So it is a higher return on your capital. Now let's take a look at the downside, right? We also want to always take a look at our risk. So risk is very important as well. So let's see what's the risk in terms of percentage. When it comes to the poor man's covered call, so naturally it will be higher because your cost is lesser. So let's take a look. $892 we divided by the cost again, 3,736. So let's say if the stock goes down to $70, right, we lose roughly 23.8%, right? So that's quite big, right? Now let's take a look at the covered call. The covered call position. All right, let's see the loss here. So it's $1,056. Let's divide it by the cost, 8,056. So you can see the loss is slightly lesser in terms of percentage wise. So here's the takeaway for this. That means that if you want to get into a poor man's covered call position, you also want to take into account that there's a possibility that you could lose the money. So if you're going to lose the money, you don't want to put all your account or all your money which you have the capital into just one position. You want to diversify and allocate them according to your risk. Alright, so let's have some takeaways for the covered call position and the poor man's covered call position, and you can decide for yourself which one is better for you. So first of all, the covered call position, it's much more expensive because we're buying 100 shares, whereas the poor man's covered call is cheaper because we're buying a long call option which is considerably lesser in cost than the 100 shares. Next, the covered call position in terms of dollars is actually higher in terms of profit, and the poor man's covered call is lower in terms of the profit, but then the risk is also higher for the covered call position, right? Because your risk is on 100 shares, whereas for this is on what you paid for the call option. So for the covered call position, we have seen that the return is actually lower, again simply because you're buying 100 shares, whereas for the poor man's covered call, your profits is on a lower cost, right, on the long call option. And the most important thing is that the covered call position actually has no expiration date. So for shares, you can hold for as long as you want. So if for some reason when you entered into the position, right? The stock goes all the way down and it takes a long time before it finally recovers and goes up, right? So in a covered call position, right, you can just hold on to the shares, right? There's no risk or any complications involved because there's no expiration date. But the poor man covered call, right? The poor man's covered call has an expiration date, so you need to keep in mind about this, because if when there's an expiration date, you ideally want the trade to work out before the long call expires, because if it expires and you're still in loss, then there's going to be some complication there because you're not sure what to do, right? Are you going to just lose the money there? Are you going to exercise the option? Are you going to roll the option? So there's much more intricacies which I'll cover in another separate video on this, but you just need to keep in mind. So which one is more suitable for you? So if you are taking more of a long-term investment approach, right, you want to hold a stock for a very long term and you don't want to bother about this expiration date, then you might just want to go simply just for the covered call position. Go for 100 shares and sell a covered call each time, right? Your return will be lower, but you don't have to worry about how long it takes for the market to go back up. Now, if you want to go more for a swing trade, maybe you want to be in the position for a shorter time, around 3 to 6 months, maybe even up to a year, right? Then a poor man's covered call position might be more suitable for you, because this way you can get a higher return through the leverage of options. You can get this at a cheaper price, a long call option. The very first tactic is what I call the extrinsic value manipulation. All right, so first of all, let's just have a quick recap on what the poor man's covered call is. So the poor man's covered call consists of two things. You have the long call option, and what we want to do for this is to buy the deep in the money call, and then we sell the call option, which is a short call option, which is the covered call. All right, so extrinsic value manipulation is basically this. So for our long call, we want to pay as little extrinsic value as possible, and for our short call, we want to cover as much of the extrinsic value of the long call as possible. So here's what I mean. All right, so the long call option, deep in the money call, right, we have two components to its value, right? We have the extrinsic value and we have the intrinsic value. And then for the short call option, which is the cover call, we are only basically going to sell the out of the money call option. So this is 100% extrinsic value. All right, so down here we are paying for the extrinsic value. Here we are receiving premium, right, in terms of extrinsic value, right? So extrinsic value, basically we already know, goes to zero when the option expires. So as much as possible, we want to buy a very little extrinsic value, right? So the idea is here. The idea is that we want this extrinsic value that we receive for selling our cover call to fully negate the cost of purchasing this long call option, the extrinsic value portion. So let's say if we have paid, let's say $1 for this options extrinsic value, ideally we want to collect about $1, right, or as close to $1 as possible, so that these two will cancel each other out, and that means we don't pay anything for extrinsic value, right? Instead, we will only be paying full value, which is the intrinsic value, right? We want to pay only intrinsic value because intrinsic value basically is the call value of the option. All right, so let's take a look at the option chain. So I'll share with you my ideas and also what my thinking process is when I'm selecting the strikes. All right, so first off, I want you to take a look at this extrinsic column. All right, this green box down here is the extrinsic value for the corresponding option strike. All right, so first off, I will always look at the long call option. So the long call option, the first thing you want to look out for is, you know, the days to expiration. How many days there is left to the expiration of this option? Now, there are people out there, right, in the YouTube, you'll see that a lot of them talk about, you know, buying 180 days or so around there. You know, that's definitely viable. But what I like to do is I like to go all the way to the furthest date available. I want to go for the leaps, right? The reason is because I want to give myself more time to be right. Because what happens if, let's say for example, you buy a 180 days days to expiration call option, and the stock actually doesn't work out within that 6 months, right? You have 6 months for it to work out. So what happens then? Do you exercise the call option? Do you sell it away for a loss? Do you roll it? What do you do? So it becomes more complicated then, right? So what I prefer to do to remove all the complications is to buy a longer time period option. So this way, not only do I have more time for the trade to work out, and especially if I am buying it on a good fundamental stock, a fundamentally good stock that I know that will go up in the long term, then I have no worries, right? Even though if I'm caught in a position where it starts to go down temporarily, right? So when you have an option with a very long days to expiration, your theta decay is very little, right? Theta decay basically is the depreciation of your extrinsic value, because as each day passes, this extrinsic value, all right, will start to decay, will start to slowly get to zero at expiration date, right? So the thing with this theta decay is that it really picks up only when it gets closer to the expiration date, right? So as if it's very far out, as far away as it is, right, when there's many days left, the theta decay is actually very little. So the whole idea here is, because I am buying a long call option, that means I'm buying extrinsic value, I want to have it sort of working for me, right? I want to slow down this decay as possible. I want to slow down this depreciation as much as possible, and that is to go for a further away days to expiration. This way it decays slower, and at the same time I want to pay as little as possible. Remember, we want to pay as little extrinsic value as possible for a long call option. So if you were to take a look at this option chain down here, ideally we want to buy this option because it is only 50 cents, right? 50 cents is just $50 per option contract, and $50 you can hold it for 542 days. So that is very little, but we do not stop there. We do not say that we just go for the cheapest, because you can see this would cost you roughly about $47. So there's about $4,700. So the other rule which I have is that I do not want to pay more than 50% of what I would pay if I bought 100 shares of the underlying stock. So what is the current stock price right now? Let's just take a look. So without looking at the stock price, you can see I do not have the stock price current bid and offer here. We can just actually take a look at the option chain to give us an idea of where the stock price is actually currently trading, right? So you can see in the gray box down here, it's highlighted, right? This highlighted down here, which means to say this strike price 80 and 81, it is in the money. And from anywhere from 82 all the way onwards, right, up to 92 there, you can see this is out of the money. So we know that the current strike price, or rather the current stock price, is somewhere in between 81 and 82. So let's just give $81.50 is where the current stock price is right now, right? So $81.50, if you were to buy 100 shares, how much would that cost? All right, that will cost you $8,150. So what this means is that I do not want to pay more than 50% of this, which is roughly $4,075. So I want to choose a long call option that does not cost more than $4,075. So which of it fits our criteria? Well, the one that fits our criteria would be these two options right here, right? 40 and 45. So strike price of 40 is about $42.40, which is not too far off the 50% mark. So I would also consider this, because you see we are paying very little in terms of extrinsic value. So the two strike price which I'm looking at is 40 to 45. All right, now there are some people that's telling you that instead of going for this deep in the money call options where you pay very little extrinsic value, they are telling you to go, you can go for at the money or even out the money, right? The problem with that is that you're actually paying in a lot of extrinsic value. Let me take a look at this, right? You're paying $11.95 for this. So it means the market has to move above this price, move above $11.95 in order for you to break even on your price. Whereas for this side, you can see that the extrinsic value is much lesser. So it's much easier for you to break even and even profit on a move on the underlying stock, right? So if people is telling you to, you go ahead, you can buy the cheaper ones. As you can see, it's only like $13, $12 that you can buy. You need to realize that the underlying stock has to make a bigger move in order for you to profit at the end. So this is what you want to keep in mind. All right, so now the next thing I want to take a look at, right, would be the covered call price. So let's take a look at the covered call. Once we have already identified the strike price which we want to go at, roughly around 40 to 45, the next thing we want to take a look at would be the covered call, right? So this covered call, first we want to take a look at the expiration date. So generally I like to go for anywhere around the 30 days mark, which is a very good place where you can have a decent decent premium. At the same time, you have a far enough strike price so that you can make on the intrinsic value of the option, right? So there are some people that are saying that, you can go for the weekly covered calls, right? You can sell weekly because you can get a higher return. Well, you can have a higher return, but what you want to keep in mind is that when it is closer to the expiration date, it means that you will have to choose strike prices that is closer to the current strike price, right? So most likely you may have to choose like $83 in order for you to get a dollar premium, when right with 24 days out you can choose the 86 strike price and get about $1 premium. So what this means is that you've actually kept your intrinsic value gain, right, to just the strike price which you sold the covered calls at, right? So this is one thing you want to keep in mind. So for me, I like a good balance. So anywhere around the 30 days would be good. So the next thing you want to take a look at is the premiums that can potentially help you offset the premiums down here which you have paid. So if you are looking at this two strike price, we're going to pay roughly about 92 cents and $1.57. So we are going to take a look at the extrinsic value down here, which we can sort of offset that, right? So which are the ones that we can use to offset? Let me just get a highlighter here. So which are the good candidates? Well, the good candidates will be this one, this one, this one, and even this one, 93 cents, because it just nice covers this. And actually we can even go for the 82 cents, 72 cents, and 42 cents, because remember, this is just the first covered call that we are selling, right? So how many covered calls can we sell? Right, we simply just take the number of days of expiration. All right, take 542 for the long call, and we divide it by this options, the cover calls expiration date. So we can see it's roughly 22 days, right? So we have roughly 22 cover calls we can sell. But as a good number for us to use, I would say 50% of that. Because let's say if the market was to go all the way up and it goes past your strike price of your cover call by a lot, then maybe you might not even be able to roll, or it doesn't expire worthless. So in this case, we took 10. Or on the other hand, if the market was to go down the moment you initiate the poor man's cover call position, then you may reach a point where the market probably went until so low, right? The stock went so low that the only cover call that you can sell is below the entry price of your poor man's cover call, which is not what you want to do, because if the market does shoot up, then you're going to lock yourself into a loss. So that's not what you want to do. So let's take a good gauge of roughly 50% of that. So that's about 10 covered calls. So 10 covered calls, even if you were to get 43 cents only just for the premium, for one cover call, you times 10 of this, you get about $4. So $4 more than cover all this extrinsic value that you're paying for. All right. So the next thing I want to take a look at is delta, right? So the delta. So generally for poor man's cover call, I tend to be a little bit more aggressive in terms of my cover call selection compared to a normal cover call, as if I was having 100 shares, right? So that's because with 100 shares, if the if the stock, if your cover call gets in the money, your stock gets called away. But in this case, the poor man's cover call, you don't have 100 shares, right? Rather, you have this long call option. So long call option has this extrinsic value which you're buying, and because of this extrinsic value, it's going to decay. And if decay, I want the market to quickly go in my favor as quick as possible. So I tend to be a little bit more aggressive in terms of the cover call for the poor man's cover call. So this way I can get more premium. So anywhere between around 15 to 25 to even 30 deltas would be pretty good, and I have a nice distance, right, between the entry price which I entered the poor man's cover call and where the cover call strike price is. Okay, so I want you to take a look at the strike prices all down here and all this extrinsic value. All right, and then tell yourself, which is the one that you might choose, right? Which is the one you would choose, all right? Give a second down here. Okay, so have you come up with an answer? So for me, most likely I would go for this 93 cents, right? So because 93 cents, you can see it fully covers this extrinsic value of this strike price. So chances are I would go for this strike, which is at $40, strike 40, and then I don't mind paying a little bit more, right? Slightly more than the 50% of what it takes to buy 100 shares, but that's fine, right? So because I can cover it in just one covered call, I wouldn't mind selling, or rather I wouldn't mind buying this strike price, right? And I get a pretty good distance away from the current strike price, right? The current strike price is 87. So that gives about, $6 in terms of intrinsic value, which is pretty good. Now, the other thing I want you to take note of delta is also the delta can be used as a gauge of probability of being in the money, right? So a delta 24 just means there is a 24% chance that the market is going to be in the money, or rather this covered call is going to be in the money at expiration date. this is what you want to keep in mind. So this is how I would select my poor man's covered call strike for both the long call and this covered call. So if this has been helpful for you, right, you feel that this has really helped you, I would appreciate it if you would just click the thumbs up button and also subscribe so you can see more videos like this in the future. Alright, so tactic number 2 is timing entries. So timing entries basically means that you want to time your entries for when you enter the poor man's covered call, because the poor man's covered call, after all, is a bullish strategy, right? It's a bullish option strategy. That means you want the market to go up when you enter, right? So the last thing you want to do is to enter your poor man's covered call down here, and then the market didn't go up. Instead, it subsequently went down. So in this case, you'll probably be cursing yourself. You know, why did I buy at this point, right? I should have chosen a better entry price to enter, so this way the market will go in your favor. So this is what tactic 2 is all about, and I'm going to share with you 3 patterns that you want to take note of. You want to have it ingrained in your mind so that you can use it as a very good potential poor man's cover call entry, or any bullish option strategies for that matter. All right, so the first is what I call the continuation pattern. So continuation patterns, so in this case, is an uptrend, right? An uptrend is when the market is forming what you call this higher highs and higher lows. All right, so you will only normally see this pattern when the market is in a bull market, all right, when it's in an uptrend. All right, right now, if the market is in a bear market, all right, or when the market is crashing, you will seldom see this pattern. But the market, when it eventually goes back to a bull market again, then you will see a lot of this pattern. So as you can see, it's forming this higher highs, higher lows, and it's going higher high again, higher lows. So the point in time where you want to identify this entry points is when the market is making this higher lows, right? You can see this is a higher low area down here, and you want to coincide this with the stochastic oscillator. You want to see that it is oversold, right? If you have seen my previous videos, you'll see that I kind of like this stochastic oscillator, because it gives me a very good gauge of what the market sentiment is, what it's going to do, right? Now, of course, one thing to bear in mind is that this is not, of course, 100% accurate. It's not like every time it's oversold, the market is definitely going to go up, right? No, it's not. It doesn't do that all the time, right? But rather, this is a gauge of probability. So remember, with options, with trading, everything we're going to do is all in terms of probability. So at this point of time where the market is oversold, there is a higher probability of it going up than it is to go down. Because would you rather enter a poor man's cover call, right, a bullish strategy, when the market is overbought, right? It doesn't make sense, right? So you rather wait until it's oversold before you enter into a bullish strategy, because this way it has a better chance of it going up immediately after you enter into the position. So for the continuation pattern, what you want to look out for is for this higher lows. And when this higher low happens, you want to take a look at the stochastic oscillator and see that if it becomes oversold. So as you can see, there are 2 instances here where it coincides with a higher low pattern, and the market, all right, rather the stochastics is showing an oversold. So these are very good places where you can get into the poor man's covered call. Okay, so the second pattern you want to look out for is to find support areas. Again, support areas are basically the places where the market has difficulty going below. So it's normally below the previous low. So you can see this is a previous low. So if I were to just stretch my line across down here, just draw a line across here, you'll see that there are many instances where the market would bounce off these levels, right? And the reason why the market, right, was to bounce off this area is because there's a stronger buying pressure, right? There's a stronger buying volume than selling volume. So there are people in the market saying, right, why the market moves is because there is more buyers than sellers. All right, they say that the market is moving up because there are more buyers than there are more sellers, but this is actually not true, right? The reason is because it is not the number of buyers that move the market. What moves the market is the volume, the size of your transaction. So for example, if there are 100 people down here and they all want to sell 10 shares each, right, 10 shares each, the total number of shares down here would be 1,000 shares, right? So 1,000 shares they're trying to sell down here. Now, what if you have, say, just one person down here, and this is an institution, and this institution wants to buy 10,000 shares? So do you think the market would go up or would the market go down? right? There are more sellers, right? There are 100 people selling, but they're only selling 10 shares each. But there's one buyer down here and he wants to buy a whopping 10,000 shares. So obviously the market will go up because the market moves because of volume. There is more transactions here. There's more shares wanting to be bought than there is to be sold. So what happens is that this guy down here, one person, he will buy up all this 1,000 shares and then he will have a leftover of 9,000 shares. So if people cannot clear this 9,000 shares, they cannot sell enough for the 9,000, guess what? The market will keep going up. So that is why the market moves. So if people tell you, or if you hear this, they say to you, you know, that the market goes up because there are more buyers than sellers, then you know they don't really know what they're saying. And this is something that I do day in, day out when I was in the proprietary trading desk, because all we look at is just this order flow. We call it order flow because we see the number of orders and transaction going through. All right, so I've gone on a tangent down here, so I apologize for that, but I wanted you to know that so you have a better understanding of how market moves. But okay, back to this. Basically what we want to do is we want to look at support areas, right? Support areas, basically you want to find a previous low and then you draw a line, a box, an area where there is, you know, so for this you would draw an area something like this, so you can see that this is the area where the market tends to bounce off. Right, so you want to coincide this again with the stochastics, right? So you can see each time whenever the market is trying to test the previous low, this support area, and when it coincides with a stochastic reading of oversold, the market went up, right? Each time it went up. So again, this is all about probability. You can see that it tends to work pretty well when the market is going sideways. So this is areas where you want to get into the poor man's covered call. So it's definitely much better than if you were to get in this area here, then you have to experience this drop before it comes back up and you still haven't made money on your poor man's covered call, and at the same time your long call is deteriorating in value, right? So you want to be smart about this. Find support areas to enter. All right, so this is the second pattern that you want to look out for. Now the third and last pattern would be the reversal pattern. So this reversal pattern, basically what we are looking for is a bullish reversal pattern. So this happens when the market is in a downtrend. So remember previously we talked about uptrends when the market makes higher highs, higher lows. For a downtrend, it is an opposite. All right, it's the opposite. It will be making lower lows and lower highs, right? So we know this is in a downtrend, so you can see this is what it's doing, right? It's making lower lows, lower highs, right? So this is what we want to look out for. When it makes a lower low, all right, we want to see try and break below a previous low. So you can see down here it tries to break below this previous low, but it couldn't. Instead, it closed above, and it closed with a bullish candlestick pattern. All right, this is a bullish candlestick bar, and then as you can see, it formed this lower low. But then you want to take a look at the stochastics. So now the stochastics, not only is it used to see oversold or overbought readings, we also can use to see divergence. So divergence is when you see there is a difference in terms of the wave pattern, all right, between the stock price and the oscillator, this stochastic. So you can see the price is making a lower low, but then the stochastic is making a higher low. So this is what I call, you know, divergence. There's a divergence. That means it indicates that the price has a higher chance of it going up than it is to go down. So this is a good time for us to enter into the poor man's covered call. So again, let me just remove all these drawings for you so you can see it better. So again, what we want to look out for is a lower low pattern, this downtrend pattern where it's trying to make this lower high, lower lows, and then we want to try and see it break a previous low, right? A previous low, and then we want to see it close above this previous low. So once we see that it's closed this previous low, we know that this is a support area. Remember from the previous pattern. So there's a support area here. And then now let's take a look at whether there's any divergence. So this is forming a lower low, whereas our stochastics, all right, this stochastics you can see is forming a higher low. So here we know there is a bullish divergence, which means, does it mean it will 100% go up? No, it doesn't mean that. It just means there is a higher probability of it going up than it is to go down. All right, so this is the three patterns. Now the third tactic is what I call legging in, and this is the most advanced tactic of all, and if you use this right, it can really give you an edge in terms of the profits that you make, right? And this is something that I learned when I was at the proprietary trading desk, when I was with the proprietary trading firm. So the proprietary trading firm, if you're not familiar, is basically a place where they hire traders like myself, and then they will just give you funds. They will fund your account, and then you will, if you make money on the funds that they give you through trading the market, they will give you a profit share, right? If you don't make money, then you go home empty-handed. So back then when we were doing this legging in, right, I was at the futures desk, right? So at a proprietary trading firm, I had been at the equities desk, and I've been at the futures desk. So at the futures desk, what we did is what we call spreading. So spreading basically is just finding two very correlated, highly correlated instruments, basically financial products. For example, like the QQQs and the spiders, they are very highly correlated. So what we would do is we would buy one and we would sell one. So back then at the proprietary trading firm, I was doing the treasury notes, right? I was doing the 10-year treasury notes as well, spread it against the Australian 10-year T-bond, because they move very similar to each other. So as an example, let's just use this broad-based index. So basically what it means is that, let's say for example, we want to get into this spread. What we would do is when the market is going up, remember, they will move in tandem. If QQQ goes up, spiders goes up. If spiders goes down, QQQ generally go down. So what we do is that when it goes up, I will basically just enter a buy order down here. And then once it goes up a little bit, I'll enter a sell order on the spider. So this is what you call the spread. So you're spreading this between these two products, right? Anyway, the point I want to make here is that with options, you can do spreading as well, right? So remember, when you enter the poor man's cover call, usually we enter it as one order ticket, right? We do the long call and the short call together in one order ticket. So this gives us the net price, right? Because you already take the cost into consideration, and then this is the net. So maybe this, probably as an example, maybe this long call would cost $38, and the short call would probably cost 64 cents, right? 64 cents plus 36 cents, yeah, that's $38. So this gives you the net price down here, right? So when you're doing legging in, you do not enter this as one order ticket. Instead, you split them up. So legging in basically is the process of entering into the legs of a spread separately. So first, you will buy the long call option first. We will buy this first, and then we wait for the price to go up. Then we sell this covered call. So you might be wondering, why do we want to do that, right? And the reason we want to leg in is because it can improve your entry price, and then it can increase your profits as well. So let me give you an example down here. So let's say, for example, as we have identified, let's say we have decided to enter the poor man's cover call when the price is somewhere around here. Okay, so let's say we enter the long call first, and let's say we get a long call for $10. And let's say at this point of time, let's say we are looking to enter the 136 covered call. So let's say it's the premium at this point of time is $1. All right. So normally, if we want to enter the poor man's cover call, we enter as a single order ticket. So when the price is here, we enter this both simultaneously. So this gives us a net price of $9. Now with legging in, what we want to do instead first is we want to enter this first and wait for the market to go up. So once the market go up, then we sell the cover call at the strike price, right? So we have determined previously it was 136. So at this point of time, this strike price, this cover call no longer goes for $1. How much does it go for, right? It increases in price, because as the market goes up, this out of the money call becomes closer towards the current strike price, or rather the current stock market price right now. So this no longer becomes $1, maybe this now increases to $3. So instead, right now, your net price would become $7. So you made a price improvement of $2, and you still had the same strike price as previously, right? Previously, you got the same strike price, you only could sell it for $1. Right now, you could sell it for $3. So you still keep the same intrinsic value profit if the price were to go up. So this is all about legging in. Now, the other way of legging in, or rather the other thing you would do of legging in, so let's say for example, instead, let me just clear this drawing here. So again, let's say we buy this at $10. All right. So let's say you want to sell the premium of your covered call for $1. And at this point of time, when you first entered the long call, the 136 strike price is giving you $1. Right. So you told yourself, I want to pay a maximum of $9 for this spread. But instead of going in at this price, you wait for the market to go up first. So that means you enter the long call. You wait for the market to go up first. and then suddenly you'll see that previously this 140 strike price, previously it was probably only going for, let's say, 25 cents, right? But because the market has gone up, right now this covered call is now going for $1, right? So instead of selling this one, you said that you wanted to lock in the premium, you want to ideally sell for $1. So now you have a net price of still $9. So you sell the highest strike price, and then now not only do you get the same net price as you would if you sold this year, but right now you have an increased potential profit in terms of the intrinsic value, because now your profits are no longer kept to 136, because right now your cover call is at 140. So you can see here, not only do you get this is a better price because you're getting at a further strike price, you increase as well your intrinsic value gain. So right now you could get a $4 intrinsic value gain down here from 136 to 140. So that is why you might want to leg in. Now you might be thinking, legging so good, are there any risks? Yes, there are risks. So this is what we would call at the proprietary trading firm, we call this lagging risk. So a lagging risk is basically where you had a mistake in lagging, or rather where the price starts to drop down. So this is where you get a worse entry price, and instead of getting increasing your profits, you actually lower your profits. So what happens? So let me just show you what happens. So let's say, for example, you want to leg in, and again we enter the long call first, and this time it's for $10. All right, same $10, but instead of the price going up, the price actually went down, right? You entered here and the price went down, and previously you wanted to sell, let's say you wanted to sell, okay, let me just remove this. Let's say previously that you wanted to sell at the 136 strike price. All right, from the previous example, remember $1 is the strike price which you want to sell at, but then because the market went down, this no longer becomes $1. This suddenly becomes only maybe 25 cents. So now, if you want to sell this cover call, you'll be getting lesser than if you would have if you just sold it previously when you entered this long call. So now you get a worse entry price because now you have to buy it for much more than you would previously. And let's say if you say that you want to still keep that $1 premium, that means you still want to receive $1 for this covered call premium. So what do? You have to compensate it, right? So you have to, instead of selling at 136 strike price, maybe now you have to lower your strike price, right? Maybe you have to lower to 130, then you can get the $1. So what happened here? Although you kept the net price the same, as though as if you had sold it when you first initiated the poor man's cover call, but right now you have the same night price, but your intrinsic value has decreased because previously you could have a potential gain on the intrinsic value portion of all the way up to 136, but right now you only can gain about 130. So right now suddenly this poor man's cover call is really looking like it's going to really make you a poor man, right? So it's not going to be as good as if you had entered originally one order together, or together one at one time, right? So that is the risk of legging in. But that is why when you're using this tactic, you want to combine it together with tactic number 2, right? The second tactic which I shared with you was the entries, right? You want to time it with entries. So let's give a quick recap of what are the 3 patterns you want to look out for. So the first pattern you want to look out for, remember, is the continuation pattern. It's when the market is in an uptrend where it's forming all these higher highs and higher lows, right? So what you want to look out for is when the market is forming this higher lows, this higher lows, and then you want to see the stochastics, right? And if the stochastics is at the oversold region, then this is a good time for us to enter the poor man's cover call. So this is the continuation pattern. Now the second one is the support area. Right, so we know that the stock, all right, will be moving in like consolidation in this horizontal lines. All right, so we want to identify these support areas, and then we want to look at the stochastics as well to see whether is it oversold, right? And if it's oversold, and it coincides, if it's oversold and it coincides with break of the previous support area, or it tries to break the support area, it cannot, right? Then this is a good time again to enter into the poor man's cover call, right? So there's the second pattern. Now the final pattern is the reversal pattern. So the reversal pattern, specifically we're looking at the bullish reversal pattern. That means we're looking for a downtrend, right? So this is the opposite to the uptrend. We are looking for a lower low and then the lower high. So what we're looking for is for a break of the previous low, and then we want to see that, right, it has trouble breaking below and then it closes above. And once it closes above, we want to take a look at the stochastics to see whether there is a divergence, right? So this is making a lower low, as you can see. So we want to see that our stochastics, right, is making a higher low. So this way, there is a divergence. So this is when we would enter into the poor man's covered call. All right. So by the way, please ignore all these messy drawings. Kind of look like the Madden NFL playbook. All right. So anyway, I hope this video has been helpful for you, right? I give you an insight into what I look at, what I'm thinking when I'm entering into this trade, so you can do so for your own poor man's covered call as well. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.